This hearing of the Subcommittee on Capital Markets, Insurance, and Government-Sponsored Enterprises will come to order. Pursuant to the committee rules, each side will have 15 minutes for opening statements. Without objection, all members' opening statements will be made part of the record. I want to recognize and welcome the many members of the full committee participating in today's hearing who are not members of the subcommittee. And I ask unanimous consent that Ms. Capter be allowed to participate in today's hearing and that Ms. Griffith be allowed to submit written questions for the record. Without objection, it is so ordered. We meet today to examine the much publicized and hotly debated mark-to-market accounting rules. A diverse range of opinions is gathered for what I hope will be a thoughtful and constructive discussion. Previously, I've taken the position that the Congress should not interfere through legislation in the area of establishing specific accounting rules. It seemed best that such technical work be left to the regulators, standard setters, and financial experts. We can, however, no longer deny the reality of pro-cyclical nature of mark-to-market accounting. It has produced numerous unintended consequences, and it has exacerbated the ongoing economic crisis. If the regulators and standard setters do not act now to improve the standards, then the Congress will have no other option than to act itself. To say that the Congress will have to act is not to advocate an outright suspension of the mark-to-market accounting. If we do away with this standard entirely, accounting will revert to the very kind of subjectivity and sleight of hand that made mark-to-market necessary in the first place. The standard does not provide transparency for investors, but its strict application in the current environment is, to many instances, distorting rather than clarifying the picture. Take the case of the Federal Home Loan Bank of Atlanta. Last September, the bank estimated that it would lose $44,000 in cash flows on 3 private label mortgage-backed securities starting in about 15 years. The magic of mark-to-market accounting required this relatively minor shortfall to be treated as an other than temporary impairment loss of $87.3 million. I find that this accounting result to be absurd. It fails to reflect the economic reality. We must correct the rules to prevent such gross distortions. As our witnesses explain the implications of this standard and offer solutions to improve its application, we must bear in mind that fair value accounting is not one uniform rule affecting all parties to whom it applies in the same manner. Many industries have been hit hard by mark-to-market rules, especially the financial services sector. Moreover, one industry's predicament may require a unique accounting treatment or regulatory forbearance that will not solve another sector's problems. In pursuing improvements, we need to recognize this fact. We also need to recognize that these matters are technical and complex. Instead of confining our words today to sound bites that too often mischaracterize mark-to-market accounting, we need to explore these complexities and enrich our understanding of the issues. Those following today's proceedings are most interested in progress and solutions. Accounting regulators and standard setters need to offer us an achievable, concrete idea of what they are doing. As I said earlier, they must also tell us precisely when they will act. In my view, we can no longer wait 15 years, 15 months, or even 15 weeks for change. We need action much, much sooner. Bank regulators must also consider liberalizing regulatory capital requirements and granting reasonable forbearance in the current economic environment. The Office of the Comptroller of the Currency can be of particular assistance on this issue. I therefore look forward to the agency's testimony today. Participants on our other second panel will offer us a wide variety of views from the private sector. The participants on our first panel also need to listen closely to the views expressed during the second panel. These comments will help in the tailoring of specific remedies to address particular needs. One idea worthy of consideration is separating an asset's losses due to credit risk from its losses due to liquidity risk when using mark-to-market accounting. In sum, mark-to-market accounting did not create our economic crisis, and altering it will not end the crisis. But improving the application of a fundamentally sound principle that is having profound adverse implications in a time of global financial distress is imperative. Therefore, our hearing today is about getting Financial Accounting Standards Board and the Securities Exchange Commission to do the jobs they are required to do. Emergency situations require expeditious action, not academic treatises. They must act quickly. I would like to recognize the ranking member, Mr. Garrett, for 3 minutes for his opening statement.
Thank you, Mr. Chairman. Before I begin, I just seek unanimous consent to enter into the record a letter by our member from California, Mr. Miller, who cannot be with us today because of health reasons, and it's a letter to Mary Shapiro, Chairman of the SEC.
Without objection, so ordered.
Thank you. And thank you, Mr. Chairman, for holding this important hearing. I'd like to also begin my remarks by noting that I agree with the Chairman and Chairman Frank and Ranking Member Baucus that Congress should not be in the business of writing accounting standards. However, I do believe that Congress should perform its proper oversight function. It's essential that we examine in greater detail what role current accounting standards and the applicable application of these standards have made in the continued deterioration of the marketplace. Now, since the formal adoption of Financial Accounting Standards 115 in 1993, and continuing with the various other standards up to including FAS 157 in 2006, the U.S. financial system has moved away from a historical cost accounting system where assets and liabilities are valued at their amortized purchase price to a fair value accounting system whose financial assets and liability valuations are determined by what price they fetch on the open market. This system is intended to provide a reliable, real-time information to the investors about the current market value or the price of the financial assets and liabilities while minimizing management bias. I agree that it's a top priority that investors have accurate information about a company's earning potential and liquidity so that they can make informed decisions. And unfortunately, I believe that during the market turbulence over the last year, the fair value or mark-to-market accounting has prevented investors and the general public alike from obtaining a really true value of the money financial institutions, their balance sheets. This method of accounting has its merits when the market is functioning correctly, but has significant downside when the market is broken. Most profound problems occur when attempting to value illiquid, longer-term assets, such as mortgage-backed securities, in an illiquid or non-functioning market. So attempting to value these types of assets in this marketplace has caused severe price distortions, totally unrelated to any credit loss in the underlying mortgages themselves. Another problem with mark-to-market accounting that the Federal Reserve Chairman himself, Ben Bernanke, has mentioned in a speech just the other day is its pro-cyclical nature. Now, this is particularly true when coupled with current regulatory capital rules by banks. When the price of assets in a bank's balance sheets are written down, the bank has to raise additional capital by selling additional assets or stock. These sales then put more downward pressure on prices. And so it's this negative feedback loop that is exacerbated by the combination of accounting practices and capital requirements. And so I'm interested to hear from Mr. Bailey what the OCC and other banking regulators are considering to address how regulatory capital levels are examined during these non-functioning market periods. Since the financial markets began to rapidly deteriorate during the fall of last year, there have been a number of attempts by Congress and others to ensure that accounting policy setters examine the concerns raised when making these decisions. And I'm pleased that the SEC has issued their report that the Economic Stabilization Act required, but I am, as the chairman is, troubled that the lack of speed in these areas. And I realize that FASB is currently reviewing these things and using much deliberation in their process. I wish that Congress would use such deliberation in their processes and a lot of these things, but I think with the chairman we wish to see additional speed. So in conclusion, I look forward to the witness's testimony and hearing greater detail on these matters. Thank you, Mr. Chairman.
Thank you, Ranking Member. We'll now hear from the Chairman of the full Committee on Financial Services, the Honorable Barney Frank of Massachusetts.
Thank you, Mr. Chairman, and for your diligence in pursuing this. You have been one of the earliest to spot this, and I think this is a very important hearing Mr. Hurst, I will address in part. You know, I have generally been a defender of the integrity of the accounting board. For example, when there was a great push to alter by legislation accounting for stock options, I was one of those who was opposed to that. I do feel entitled to say, we told you so. The notion that if you had to expense stock options, this would have terrible consequences, that ranks along with same-sex marriage in Massachusetts as the recipient of doomsday predictions that went nowhere. But we do have to have you move now. And it is important that we get some speed. I understand, you know, sometimes acronyms are important. You are the FASB. In this one, you cannot be the Slowsby. We are going to have some movement. And the movement, we are clearly in your hands. And I say this to the SEC and the OCC, there are two things, it seems to me, that need to be done. First, more realism and flexibility in the marketing market. And I understand, look, we all react to past things. You know, my own view is that the negative impact and reaction to the allowing of Lehman Brothers to fail has had an impact on making people more nervous now. Yes, we had irrational exuberance and excessive accounting, but this is not a time to make up for the past mistakes by excessive rigidity, by pretending that there is more reality and certainty to market than there is. It should be applied with flexibility. It does seem to me, if you were talking about a member of an asset class, that the particular institution has always held to maturity and it is performing and providing an income stream, that the case for substantially devaluing that is a lot weaker than if it's a tradable asset, if there is a history that that kind of asset is held. I do not think we have had enough flexibility in how we apply them. Secondly, and this is important for all the regulators, we need to give you some discretion in how you apply, how you react to these things. And I am now asking everybody, the OCC and others, if anything in the legislation, and here's where the legislative role is, if anything in existing legislation deprives you of discretion in how you react in a markdown-to-market situation, I insist that you tell us. That's our job. Our job is to think about the extent to which we give you some discretion. There is no point in having these things be so automatic. It does seem to me, as the chairman correctly said, and he's done a lot of work on this, if the institution, if a bank has to mark down its assets, why it had to do that is something to take into account. If they did it because they made a lot of stupid decisions, that's one thing. If they had to do it because of things that happened in the economy over which they had no control over assets that are still performing, that's another. And the consequences of a write-down should not be identical in very different situations. And you have to move quickly. I was pleased yesterday. I talked about mark-to-market and uptick. We got a good reaction from the market. We're not driven by day-to-day reactions to the market. But our job is, I think, to give you the flexibility you need and to help you understand the point. I hope that within a very short period of time, working together, we will have a situation in which we will not be constantly told by the people who are the practitioners that mark-to-market is having undue negative effects and doing more harm than good.
Thank the gentleman from Massachusetts. Now the ranking member, Mr. Baucus of Alabama. 4 minutes.
Thank you, Mr. Chairman. I want to share with my colleagues on both sides of the aisle and with the panel and with the audience a true story. It's a story that happened in Alabama over 60 years ago. And it's recorded in a national bestseller by one of our colleagues because he was the little boy in that story. And that's John Lewis. John was playing at his aunt's farm one morning with 15 of his brothers and sisters and his cousins when a storm came. I don't know whether it was a hurricane or a tornado, but we've all been on those days where it starts pretty sunny and things get dark, the wind picks up, day turns to night. He records what happens there, and he relates it to years later during the Civil Rights Movement. And here's what he said. Well, what he talks about, what happened that morning, the children, his aunt rushed them in the house, and the house beginning to shake, the storm blew, and one corner of the house actually lifted up. And all the kids rushed over to that corner of the house, and it settled back down. In a few minutes, as we know from storms, I've been through one, the other end of the house began to lift up. All the little kids went over to the other end of the house, rushing back and forth. He said America sometimes is like that. You know, children in a house rocked again and again by winds, one storm after another. The walls around us seem at times as if they might fly apart. You know, that's America today. It's quite a storm. It's the civil rights movement in Alabama in 1960. So much tension, so many storms. But here's what he said. But people of conscience never left the house. They never ran away. They stayed, they came together, and they did the best they could. That is America to me, he said. Not just the movement but civil rights, but the endless struggle to respond with decency, dignity, and a sense of brotherhood to all the challenges that face us as a nation as a whole. Well, let me tell you this, gentlemen. We're in that house today. I see the American people in that house. I see lenders and borrowers. I see the Congress. I see the administration. Sometimes we're almost like children rushing from one end of that house to another. We're scared. We have anxiety like those little kids that day. But as I look around that house, and I say this because the last thing we want to do is point fingers, because that doesn't help. It wouldn't have helped then. But as I look around the house, I don't see the Financial Accounting Standards Board. I don't see the engagement. I don't see the urgency. I see the SEC, and I know that, as I said in my prepared opening remarks, we ordered a study, and the SEC reported that there ought to be changes to mark-to-market and that they were causing distortions in the system. And one of the weakest corners of that house is our financial system and our banking system. And they said it was causing real problems there. And back in January, they asked the Financial Accounting Standards Board to join the fight. I see you here this morning. I'm glad you're in the house. Let me tell you, it's a storm. We can't just sit around and talk. We need action. We need it now. Thank you.
Thank you very much, Mr. Baucus. And now we'll hear from Mr. Ackerman of New York for 2 minutes.
Thank you, Mr. Chairman. In a perfect world, with a normal and honest market, with real transparency and a strong economy, mark-to-market accounting standards make sense. Philosophically, I believe it's important for certain assets of their fair market value. But the key word, Mr. Chairman, is fair. We're in the midst of a recession whose tentacles have spread along Wall Street and constricted our credit and equity markets. In today's economy, the market value of a mortgage-backed security may be only 20 cents on the dollar, even though the underlying mortgage may be being paid in full with interest. Today's market is not a fair market. It's not a real market. It's a panic market, and it's a buyer's market. Companies are forced to mark their assets to market despite the fact that they have no inclination to sell them, are watching their company's value disappear. The great unraveling of so many firms' balance sheets is not the consequence of unsound business practices or even declining sales, but simply the result of our regulators' unwillingness to implement a more effective accounting rule that won't pull enterprises under the rising tide of an economic crisis. And let's be clear about the scale of the problem. It's not just the high-flying Wall Street traders that are suffering as a result of the mark-to-market rules. Many of the financial institutions that receive TARP funds, taxpayer money provided to keep our national credit markets operating, are lending institutions that have reserve requirements that they're obligated to maintain by law. They're forced to mark their assets down to an unrealistic market They are required to raise enough capital to maintain their reserves. In this economy, where are the financial institutions, the ones in which the taxpayers now have a major stake, going to raise tens upon tens of billions of dollars? Certainly no one from the extinct investment banks or trading companies in which they used to rely. There is, in fact, just one place for these banks to go to get the money they need to meet their legal reserve obligations: from you and me, from the members of the committee and the Congress, and in the end, always from the taxpayers. The $700 billion emergency bailout we passed last year to revive lending and increase access to credit has been subverted in good measure by mark-to-market accounting. The banks are holding on to the money, at least in part because as mark-to-market accounting standards are forcing them to write down the value of their assets, they are required to meet their reserve obligations. The problem is clear. The solution may be less so. But I'm pleased we're focused on finding it. The public doesn't expect us to be perfect, but they're right to expect us to fix mistakes once they're discovered. And we've discovered a big one. Thank you, Mr. Chairman.
Thank you, Mr. Ackerman. The gentleman from Georgia, Mr. Price, for 1 minute.
Thank you, Mr. Chairman. Before I begin, I'd like to ask unanimous consent to enter into the record testimony from Alex Pollock, who's a resident fellow at the American Enterprise Institute, dated today, Reform of Fair Value Accounting.
Without objection, so ordered.
Thank you, Mr. Chairman. I congratulate you and Ranking Member Garrett on holding this hearing. I join others in the belief that Congress should not be in the business of writing accounting standards. However, when economic realities reveal shortcomings in accounting practices, we all should be able to expect that the entities responsible for those standards will respond as quickly as possible. Process is important, but I believe that the SEC and FASB and other regulators have had more than enough time to gather information and make determinations to help ailing financial institutions. Despite the steps taken by the SEC and FASB, my constituent companies and others around this nation have yet to experience any relief. We simply cannot wait any longer for some substantive action to be taken to help institutions know how to appropriately classify illiquid assets. As we're attempting to do everything possible to strengthen our banking system and free up capital and increase lending and stimulate the economy, we must consider ways in which we might be able to do that without expending more taxpayer dollars. Importantly, providing additional guidance to companies on mark-to-market could considerably ease the credit constriction we currently face. I look forward to working with the regulators to develop positive solutions that will protect investors while at the same time providing confidence and stability to the financial system as a whole, and I look forward to doing so rapidly. Thank you much.
Thank you, Mr. Price. And the gentleman from Texas, Mr. Hinojosa, 1 minute.
Thank you, Mr. Chairman. I thank you for holding this important hearing today. I ask unanimous consent to submit my entire written statement into today's record.
Without objection, so ordered.
My abbreviated remarks will summarize concerns and recommendations for today's record. I have a few modifications to the mark-to-market accounting that I would like you to take into consideration. I earned an MBA and I can read financial statements, and it seems to me that the current mark-to-market accounting is flawed in that only the asset side of the balance sheet is examined. A well-run banking institution does not have the ability to show that many interest rate risks are offset by funding on the liability side of the balance sheet. Even in the event that there is not an interest rate offset on a bank's balance sheet, the fact that securities carry little credit risk should be taken into consideration. The day-to-day value of the investment should not hinder a bank's ongoing daily operations as long as it has enough liquidity to manage the bank's operations. I don't believe that I can give all of my statements in 1 minute, Mr. Chairman, but I would like to simply conclude and say that this current market-to-market system should be modified so that unused capital can be used by the banking system to fund growth and not be squandered into needless collections of idle recourses. I yield back the balance of my time.
Thank you very much, Mr. Hinojosa. Now we'll hear for 1 minute from Mr. Castle of Delaware.
Thank you, Mr. Chairman and Mr. Garrett, for this meeting. If anyone thinks mark-to-market is not an issue, they should see this room, which is filled both with members and with spectators, which is highly unusual for a subcommittee meeting. There's no question that this is a very significant problem. You have investors who want to know what the assets of the banks are. You have banks which are worried about their capital circumstances, and they feel that mark-to-market is injurious to that. We talk about going back to cost accounting, which may not be the correct way to go. But the bottom line is I think we need to listen carefully to those who are going to testify here today. We know we have economic problems. We know banks are struggling. There have also been studies about this. The SEC has conducted a study on fair value accounting at the direction of Congress and made several recommendations. FASB has also announced that they will be re-examining these problems and will complete their investigation by the end of the second quarter in 2009. I believe these studies are critical as well. My sense is you're going to have some solution in the middle. That's what we need to try to ascertain, and we in Congress need to help with that. This is a very important issue, I think, to the whole capital structure of banking in our country, and I hope we can work this out. And I appreciate the experts being here, and I yield back the balance of my time.
Thank you very much, Mr. Castle. And now we'll hear from the gentleman from New Colorado, Mr. Perlmutter.
Thank you, Mr. Chairman, and I want to thank the ranking member for organizing today's hearing. And gentlemen, our first panel, I will admit that I think that my colleagues have been far kinder than I feel today about this particular subject. This is a situation, and I just want to start with the definition of fair value for fair value accounting. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. We have known now for at least 6 months, since September, this has been an issue as to whether mark-to-market type of counting, fair value accounting, was exaggerating and multiplying the cycle that we're in. And whether it's the comptroller of the currency or FASB or the SEC, the SEC did a wonderful study. It's about 300 pages long already. We have been dithering while this patient's been sick, and I think given the medicine that's been making the patient sicker. And I know the chairman doesn't want us to be doing this in terms of sound bites, but the problem has been apparent now for at least 6 months. Mr. Isaac, who's going to be one of our witnesses in the second panel, predicted this 12 years ago, that if we went to mark-to-market accounting in connection with the banking industry, which is a different animal than Hewlett-Packard or Colgate-Palmolive or whatever else you might want to look at, that we would have this kind of exaggeration within the system. The SEC, I appreciate your role. You look to investors and their safety. Okay, but there are 2 other interested groups here that we must consider, and I look to the banking regulators for these, and that is the depositors and the taxpayers. And the taxpayers have been getting clobbered for the last 6 months. And we can deal with this. We need to deal with this now. This is not time for more study, but it is time for action, and I appreciate the chairman's letting me make an opening statement.
Thank you very much, Mr. Perlmutter. Now we'll hear for 1 minute from Mr. Lucas.
Thank you, Mr. Chairman. And before I begin, I'd like to ask by unanimous consent that written testimony from the former Speaker of the House, Newt Gingrich, be added to the record.
Without objection, so ordered.
Thank you, Mr. Chairman, and thank you for holding this hearing on this critical, important issue. It's important to the stability of our nation's financial system that we address the effects of mark-to-market accounting rules. The goal of mark-to-market accounting is to increase transparency and confidence. However, certain mark-to-market accounting principles have created unintended consequences that have only contributed to the disruption of the markets. These practices that are used to value assets in illiquid and inactive markets have intensified the economic downturn and threaten the health of many of our country's financial institutions. The inability to appropriately value these assets has resulted in uncertainty and work to further deepen the credit crisis. I urge the SEC and the Federal Accounting Standards Board to act quickly to make the necessary changes to mark-to-market and provide the appropriate relief and guidance to our financial institutions. Additionally, as we work to stabilize our financial system and reform our regulatory framework, it's important that we examine all economic policies that pose a systematic risk to our financial system, including accounting practices. That's why I've joined with my colleague, Mr. Perlmutter, in introducing H.R. 1349 to create a federal accounting oversight board to oversee the accounting principles and practices in an effort to provide a broader economic perspective on accounting rules in the markets. This new oversight framework will provide more flexibility in monitoring and reviewing accounting practices in the present market conditions. Again, thank you, Mr. Chairman, for this very important hearing.
Thank you very much, Mr. Lucas. And now we'll hear from the gentleman from Georgia, Mr. Scott, for 1 minute.
Thank you, Mr. Chairman. I think that to preface my remarks, I want to mention two distinctful individuals. One was William Shakespeare, who said, "The quest before us today is to be or not to be. Our quest before us today is to suspend or not suspend the fair value accounting." The other gentleman is none other than Warren Buffett. Warren Buffett on Monday on CNBC said that mark-to-market accounting should not be suspended. And he made some good arguments to that end. But he also recognized the problems associated with the effects of the impairments taken, especially on assets that are held to maturity. Warren Buffett said that the regulators should consider not requiring additional capital be held against those write-downs. If even an ardent supporter of mark-to-market accounting can point to the problems, shouldn't that problem be fixed if it can be so? So regulators don't have to resort to what amounts to regulatory forbearance. To be or not to be, to suspend or not suspend. That is the question before us today. Thank you, Mr. Chairman.
Thank you very much, Mr. Scott. Now we'll hear from the gentlelady from Illinois, Ms. Baker. 1 minute.
Thank you, Mr. Chairman. I look forward to hearing about very near-term action the SEC and FASB plan to take to correct accounting rules that many believe have failed. When I say failed, I mean rules aimed at transparency, which is important and should be preserved, but rules that simultaneously have facilitated a downward spiral of skewed financial statements, created market volatility, and required capital adjustments. I would like today's witnesses to comment on the idea mentioned in the SEC study on fair value. That study and others suggest that on the income statement and the balance sheet, we should make a distinction between credit impairments versus impairments due to other factors. In other words, can we preserve transparency and help restore investor confidence and calm market volatility by reporting separately the losses related to declines in expected cash flow versus all other changes in fair value? I urge the SEC and FASB to refrain from issuing additional meaningless guidelines, but instead to get at the root of the problem, which is valuation. With that, I would conclude and look forward to hearing from our witnesses.
Thank you very much, Ms. Baker. And we'll now hear from the gentlelady from New York, Mrs. Mahoney. 1 minute.
Thank you, Mr. Chairman and Ranking Member. 70 years ago, FDR suspended mark-to-market, calling it a destructive regulation. I am beginning to believe that providing reform or flexibility or reality in the pricing could be, in mark-to-market, could be one of the most important reforms which could help turn our economy around and help with economic growth and stability. Even Chairman Bernanke this week expressed his concern over the mark-to-market rule. And I quote, he first speaks about the importance of improved disclosure and greater transparency as a positive development, but then he states, further review, and I quote, of accounting standards governing valuation and loss provisioning would be useful and might result in modifications to the accounting rules that reduce their procyclical effects without compromising the goals of disclosure and transparency. So I truly do believe that there is a way that we can look at it. Certainly assets that are held to maturity are a different value than one that is sold today, and we certainly need to look at this. I completely respect accounting. I support your independence, the need to have an independent body, but this needs to be looked at. It needs to be reformed. It needs to be more realistic and flexible, and I feel that doing so would be one of the most important things we can do to stabilize and help our economy. I put my statement in the record. Thank you.
Thank you, gentlelady. And now we'll hear from Mr. Barrett for 1 minute.
Gentlemen, thank you for being here. In a different life, I wore a different hat. I was a small businessman. Barrett & Sons Furniture, Westminster, South Carolina, 50 years in business. Couldn't afford my stock, so I would take a loan with the bank to floor plan it. And my local bank would roll that up, sell it somewhere. And of course, according to Mark to Market, they had to mark it down to hurt on their capital. 50 years, we never failed to make a payment on time. In fact, most of the times we paid them early. There's 350,000 small businessmen and women in South Carolina, guys, and this is killing them. They can't get the credit, and they're just like Barrett's Furniture. 50 years, 60 years, 70 years, and we're killing the backbone of this nation. Listen to what you're hearing. I think you're hearing it, but I'm not sure you're listening. Reevaluate it. Look forward to this hearing. Thank you, Mr. Chairman.
Thank you very much, Mr. Barrett. And now Mr. Capuano for 1 minute.
Thank you, Mr. Chairman. Gentlemen, thank you for being here. The truth is I've tried to read through most of your testimony, but it doesn't get to where I want to go. And where I want to go, and I think all of America wants to go, I actually think that you may be the only people in America who don't want to straighten out this mark-to-market thing yesterday. Not tomorrow, no more studying. Just get it done. There's 1,000 ways to do it. If you're not hearing people, I think you'll hear from us. Get it done. And I like the mark-to-market rule in normal times. It's not normal times. Extraordinary measures are necessary. Stop dithering with it and just get it done. If you get it done right and you get it done quickly, maybe the taxpayers can avoid getting involved in this bad bank nonsense. Because all these bad assets, if properly valued and properly addressed by the accountants, can be left on the books of the people who took those risks and still not bring their companies down. This is not difficult. It was easy to put the uptick rule in, take the uptick rule out, put it in, take it out, get it back on. You know it's necessary. Don't make us tell you what to do. You know what has to be done. Just do it, please.
Now will you tell us what you really believe? Now we'll hear from Mr. Campbell for 1 minute.
Thank you, Mr. Chairman. There are those who would lay the entire problems of this financial crisis at the risk of mark-to-market accounting, and that's wrong, but it is an issue. And there are those who would eliminate mark-to-market accounting completely, and that's also wrong, because there's been permanent losses experienced in these financial assets, and if we don't recognize those permanent losses, we will have financial statements which will overstate the value and will be artificially inflating the value and health of banks, which we certainly don't want to do at this time. But similarly, we cannot be taking a long-term asset and marking it to a short-term value, particularly when in the current market there is no real market that exists to determine that short-term value. So clearly we need a middle ground. Perhaps that middle ground is a net present value of the expected cash flows, and perhaps we're going to hear some of that today. But we do need to get to a middle ground, some fair, actual, best we can estimate. I'm a CPA, I know it's difficult, but true accounting value of these assets, and we need to do it quickly. Thank you. I yield back.
Thank you very much, Mr. Campbell. Now we'll hear from Mr. Klein.
Thank you, Mr. Chairman, for holding this hearing. And as we all know, it's absolutely essential that investors have reliable information when analyzing investment opportunities. Fair value accounting principles, including mark-to-market rules, are intended to maximize transparency and the ability of investors to accurately evaluate and compare the financial statements of different business organizations. Yet in practice, as we know, mark-to-market accounting has flaws, particularly in this environment. And what we know is that in this downturn, even assets that are still performing are facing illiquid markets and determined to have little value. In some cases, this unnecessarily slashes the credit availability that is so sorely needed today. And as many of the members have said today, we are worried about small businesses and hardworking citizens in our communities that can't get loans. I'm worried about them, as everyone else is, about people who are losing their jobs because of this. Many of the banks made bad loans, and banks should be required to deal with this. But we also need to give the banking industry, in some cases, time to strengthen its financial position, and forcing them to mark assets to illiquid markets at fire sale prices has wide repercussions for the broader economy. I would suggest a temporary suspension mark-to-market rules should be seriously considered, and look forward to your comments on that.
Thank you very much, Mr. Klein. Now we'll hear from Ms. Bachman. 1 minute.
Thank you, Mr. Chair. Thank you also for this long overdue hearing. I'm very pleased that you've convened it. I wish we could rewind the tape back to last September of 2008, because during the height of the debate over the $700 billion TARP bailout, I, along with 60 other members, wrote the SEC and asked them to suspend mark-to-market and replace it with a form of mark-to-value that could accurately reflect the true long-term value of institutions' assets. More than 6 months later, we have seen some action on this issue, but not enough. Recently, I read a book that did report on FDR suspending mark-to-market accounting. The book concluded that had FDR suspended the rule earlier, the country would have been spared at least 2 years of the Great Depression. Last December, when the SEC released their subsequent recommendations, I began hearing from financial institutions in Minnesota that more could be done to both preserve the transparency of bank balance sheets, something that is critical, but also allow them to show a longer-term, more accurate value of our assets. Much could be said about undervaluing and overvaluing. However, our financial system needs to find a way to unleash capital sitting on the sidelines, both in investor pockets and on bank balance sheets, so business and consumers alike could return to a stable lending environment. I've had numerous conversations with both financial service institutions and those in the accounting industry. It seems there must be a way forward on this issue, whether it's suspending market-to-market and replacing it with something else, or altering it in a manner that would help make these clogged assets marketable again. We agree, both Democrats and Republicans, something must be done. I yield back.
Thank you very much, Ms. Bachmann. And now we'll hear finally from Mr. Manzullo for 1 minute.
Thank you, Mr. Chairman. I'm going to be asking a question. Is mark-to-market best when the market does not exist, when there is no market to value the assets? You've got a tough job, but the IRS certainly doesn't use mark-to-market when it comes to valuing the estates of the owners of these small factories in the district that I represent. So on one hand, they can't get money to run their factories because of mark-to-marketing, and yet somebody dies and IRS says, oh, this is worth X amount, and they ignore those same rules. That's the inconsistency of the message. It's resulted in the fact that, gentlemen, we could lose hundreds of factories, thousands of factories that are hemorrhaging, that simply cannot get money. This nation will collapse into a long, long depression unless something is modified with the formula that is being used for the purpose of lending out money. One of the experts on it, Rich Berg, chairman of CEO Performance Trust Capital, asked the question in terms of from the consumer, the bank manager, and the investor, the question I'm going to ask you, and I thank you for being here today, and would ask that you keep in consideration the fact in my district alone in one city, I could lose a couple of hundred factories. We're already at 14% unemployment. Thank you.
Thank you very much, Mr. Manzullo. And now I will introduce our first panel. First of all, gentlemen, thank you for appearing before the subcommittee today, and without objection, your written statements will be made part of the record. You will each be recognized for 5 minutes to summarize your testimony. First and foremost, we have Mr. James Coker, Acting Chief Accountant of the Securities and Exchange Commission. Mr. Cook, I think we have to identify the fact that your being here took an act of courage on your part. So welcome. We'll try and protect you. But if you will, summarize your statement.
Chairman Konjorsky, Ranking Member Garrett, and members of the subcommittee, thank you for the opportunity to testify here today on behalf of the SEC on mark-to-market accounting, their practices and implications. This testimony is presented on behalf of the Office of the Chief Accountant, which advises the Commission on accounting and auditing matters. Our chairman testified yesterday that these are wrenching times, and there can be no doubt about the urgency and the gravity of this matter today. Accounting did not cause this crisis, and accounting will not end it, but accounting should not make it worse. On December 30th, the Commission delivered its staff study on mark-to-market accounting to Congress. In this comprehensive study, conducted in consultation with the Department of the Treasury and the Federal Reserve, we did not recommend a suspension of fair value accounting. we do recommend improvement. Among the study's findings, we found that investors generally believe that fair value accounting increases financial reporting transparency and facilitates better investment decision-making. In addition, after careful study of the factors that led to bank failures in 2008, fair value accounting did not appear to play a meaningful role, but rather we found that failures appeared to be the result of growing credit losses, concerns about asset quality, and in certain cases, the erosion of investor confidence. We also observed that the abrupt removal of fair value accounting would erode investor confidence, resulting in the potential for further instability in our financial markets. All of our recommendations are included in my written testimony and are fully described in our study, but I would like to highlight two of our more significant recommendations. First, we recommend additional guidance be developed to assist in measuring the value of illiquid securities. And second, we believe that accounting for financial asset impairments should be readdressed. We are working closely with the FASB and others to address these and other recommendations in our study. Consistent with the chairman of the SEC, the chairman's testimony yesterday, the FASB has committed to provide guidance on valuing illiquid securities in a matter of weeks, not months. Our financial reporting system has long been considered world-class and a major national asset. This world-class reputation has been earned by our ongoing commitment to provide investors with transparency that they need to make better capital allocation decisions. This reputation should be safeguarded by those charged with the stewardship of our capital markets by continuing to hold the needs of investors paramount. Interruptions to financial stability caused by real economic factors should not lure us to suspending transparency and the accompanying clear financial picture and investor confidence that our capital markets depend upon. To achieve this, we believe an independent accounting standard setter is best positioned to promulgate financial reporting standards for all private industry, and it is important to note that the accounting standards that are the subject of this hearing, those related to fair value, are not just used by financial institutions, but by all industries. Of course, open due process, including thoughtful consideration and the input and the views of investors and the many others who play a critical role in our capital markets, is crucial to the FASB in fulfilling its mission. It's also vitally important to point out that an independent standard setter must still be accountable. Thus, we continue to believe that the FASB must be responsive to the needs of the capital market participants, particularly to investors. To be responsive, the FASB must continue on a timely basis to improve guidance available to assist preparers and auditors when making difficult judgments. Further, evaluation of the application of existing standards and practice and timely improvement where warranted are crucial to the success of an independent accounting standard setter. We believe responsiveness is enhanced by a collaborative process between all parties. My written testimony in our study outlines the history and the use of fair value accounting in broader detail. However, I would like to emphasize today that the use of fair value accounting, primarily for derivatives and for investments that are not held to maturity, were adopted over many decades and after careful consideration, including the evaluation of causes of previous financial crises. FASB Statement 157, which provides a common definition of fair value and improved transparency regarding fair value measurements, did not increase the use of fair value or mark-to-market accounting. We should not forget that investor confidence is at the heart of efficiency and capital formation. Transparency increases stability by increasing investor confidence, and the needs of investors should be the primary focus of financial reporting. Despite the call and the recognition for the need for improvement in certain practice areas, the current standards related to mark-to-market and their transparency should not be suspended. We at the SEC remain committed to advancing investor confidence and transparency in reporting during this economic crisis. Thank you for the opportunity to appear here today, and I'll be pleased to respond to any questions.
Thank you very much, Mr. Croker. Appreciate it. And next, we'll hear from Mr. Robert Hertz, Chairman of the Financial Accounting Standards Board. And again, we'll offer the same protection to you, Mr. Hertz.
Thank you, Chairman Jaworski. Thank you, Ranking Member Garrett, members of the subcommittee. I'm Bob Hertz. I'm the chairman of the FASB, and thanks for letting me participate today. Our current reporting model in the U.S. and indeed across much of the world includes both historical cost and fair value measurements. Recently, many have criticized the use of fair value in the current environment as overstating the extent of losses and capital erosion and as a factor exacerbating the crisis, and have called for it to be either suspended or significantly modified. Others, however, have applauded its use as essential in promptly revealing the extent of problem assets and deteriorating condition of financial institutions, and have urged us not to suspend or weaken the current requirements. Indeed, some, and that's investors, have urged us to extend the use of fair value to all financial assets. Clearly, there are very strongly held views on this subject. So rather than use my time to debate all the pros and cons, what I'd like to do is provide you some information about fair value and how it isn't used in financial reporting now. Secondly, on our recent and planned standard-setting actions on this subject, including how we have been responding to reporting issues emanating from the crisis and how we are addressing the recommendations in the SEC report. And finally, some observations about the role of financial reporting and its relationship to economic and regulatory consequences. Mr. Perlmutter read you the definition of fair value. Thank you. Conceptually, it is what an asset is worth currently in an exchange between informed parties on an arm's length basis and not its potential value at some future date under different economic or market conditions. And contrary to what some assert, it is not the price that would be received in a fire sale, a distress sale, or a forced liquidation. The standard is quite clear on that point. As described extensively in the SEC report, the use of fair value by U.S. financial institutions varies considerably from relatively little by many banks to more general use of so-called mark-to-market accounting by broker-dealers. Mark-to-market accounting occurs when the items are carried at fair value on a continuous basis with the periodic changes in value, that is, the mark-to-market adjustments included in determining reported earnings each period. The use of such accounting is generally limited to securities in trading portfolios and, except for qualifying hedges, to derivatives. Fair value is also used to report securities in what are called available for sale portfolios of financial institutions, but in such cases, the periodic changes in the fair value are included in what's called other comprehensive income, which is outside of reported earnings. Investments that are classified as held to maturity are carried on a cost basis. Fair value is then used also to recognize in earnings what are termed other than temporary impairments of financial assets where there has been a significant and prolonged decline in their value, as can occur in sustained downward markets. Loans held for investment, which comprise the bulk of financial assets for many banks, are carried on an amortized cost basis with allowances for loan losses that are not based on fair value. Most of these requirements have been in place for a while. Our standard number 157 on fair value that we issued in 2006 does not require any new fair value measurements. Thus, it is not surprising that the SEC report indicates that the extent of the use of fair value remained fairly constant before and after Statement 157 came into effect. 157 provides a consistent definition of fair value, a framework for determining fair value across varying types of assets and liabilities and differing market conditions, and requires significantly expanded disclosures relating to the use of fair value. So fair value is not a new concept. Further, the practice of writing down assets in periods of down markets is not new and would apply whether one used fair value or other age-old accounting methods such as lower of cost or market. What is new, of course, are the state of the markets that you all commented on. And clearly, as the crisis has deepened, the values of many financial assets have fallen significantly, and the markets for some complex instruments has become increasingly inactive and illiquid. Such conditions pose very significant challenges to the valuation process, often requiring additional data gathering and analysis and the use of sound judgment. It's challenging for the companies that hold these instruments and it's for their auditors, but it's important for investors to get a reasonable idea of the values. While FAS 157 did not specifically contemplate the current crisis, it did include guidance on determining fair values for illiquid assets for which there may be little or no transaction activity. And as the credit markets froze in 2008, our staff, together with the SEC staff, provided additional guidance on valuing financial assets in illiquid markets, which we then quickly supplemented with further guidance. Additionally, consistent with the recommendations in the SEC report and with the very good input we have received at our recent public roundtables and following many, many other discussions with constituents, we have recently undertaken a series of near-term standard-setting actions to resolve inconsistencies in the rules relating to impairments of securitized assets, which we did in January, to provide more guidance on dealing with inactive markets and distressed sales, and also some more disclosures. Also consistent with the recommendations in the SEC report, we and the International Accounting Standards Board are undertaking a joint project to more comprehensively improve, simplify, and converge our standards on accounting for financial instruments. I would also note that over the course of the past year, we have responded to many other reporting issues emanating from the crisis, including issuing new standards to improve transparency around securitizations, the use of special purpose entities, financial guarantee insurance, credit default swaps, and other derivatives. A few brief comments on the role of financial reporting and its economic and regulatory consequences, including assertions by some that the use of mark-to-market accounting has caused banks to fail and exacerbated the financial crisis. We agree with the SEC's conclusion that fair value did not cause banks to fail. We also agree with the SEC that suspending or eliminating existing fair value requirements would not be advisable. For the role of accounting and reporting standards is to help the investing public and the capital markets with sound, unbiased financial information on companies. Its purpose is not to determine regulatory capital or capital adequacy. That's a matter for the financial institution regulators. But while our roles are different, we have long-standing and I believe very productive relationships, working relationships with the regulators, wherein we share perspectives, discuss issues, and look for ways to complement and bridge the reporting needs of investors with those of the regulators. Of course, good accounting and reporting can have economic consequences, including potentially leading to what some term as pro-cyclical behavior. Reporting the deteriorating financial condition of a financial institution can result in investors deciding to sell their stock, to lenders refusing to lend, to the company trying to shed problem assets, and to regulators in the capital markets recognizing the institution may need additional capital. Indeed, such pro-cyclical actions are being taken by individuals and families as they see the falling value of their homes and of their 401k accounts and decide to spend less, to save more, to sell investments, to raise cash. But I think few of us would suggest that we suspend or modify the reporting to individual investors of the fair values of their investment accounts. Thus, to the extent there are valid concerns relating to pro-cyclicality, I believe these are more appropriately and more effectively addressed through regulatory mechanisms and via fiscal and monetary policy than by trying to alter the financial information reported to investors. Finally, I would like to, in these very challenging times, assure all the members of the subcommittee of FASB's continuing commitment to work actively and constructively with all parties on these very difficult but very important matters. Thank you.
Thank you very much, Mr. Hurst. And now we'll hear from the final member of the triumvirate, Mr. Kevin Bailey, Deputy Comptroller for Regulatory Policy, the Office of Comptroller of the Currency. Mr. Bailey, we won't offer you any protection.
Chairman Kanjorski, Ranking Member Garrett, and members of the subcommittee. Thank you for the opportunity to be here today to discuss fair value accounting and the practical challenges faced by banks and bank supervisors in the implementation of those standards. The unprecedented disruption in worldwide financial markets that we have seen over the past 18 months has raised a number of issues about mark-to-market or fair value accounting, including the very important question of how or even whether fair value concepts should be used in financial reporting and bank regulatory capital. Implementation of these standards in the context of the current crisis has also caused many to question the extent to which fair value measurement has contributed to procyclicality in the broader economy. As the primary supervisor for national banks, which hold nearly 70% of the nation's banking assets, the OCC has significant interest in the impact of fair value accounting, especially its effect on capital, a key measure of a bank's health and ability to lend. The OCC and the other federal banking agencies use current accounting standards as the starting point in determining inputs to regulatory capital rules, but make an independent assessment of bank risk exposures and activities in determining standards of capital adequacy. There are two critical elements in the development of our capital adequacy standards that I wish to highlight today. First, our capital adequacy requirements must provide an accurate and timely assessment of a bank's individual risk profile, reflecting a consideration of all material risks. Since these regulatory capital rules are the basis for much of our supervisory program, including limits on loans to one borrower and the Prompt Corrective Action Early Intervention Program, an accurate capital regime is critical. Second, it is also important to limit excessive and unnecessary volatility in capital that could disrupt credit markets and prevent banks from effectively serving their customers. The banking agencies have worked diligently to balance these important objectives as they relate to fair value measurement. Stated generally, and except for assets that the bank intends to trade in the short term, current risk-based capital rules seek to neutralize the effect of temporary fluctuations in the value of financial instruments and incorporate more permanent decreases in value in regulatory capital ratios. We believe that this approach to fair value measurement strikes the right balance between the need for banks to recognize more permanent changes in the value of their assets and capital, while not subjecting banks to wild swings in measured capital levels. With that said, we do believe that enhancements to fair value measurement can help address a number of legitimate issues that have been raised during the current crisis. The question in front of us is not whether banks should or should not be subject to fair value accounting. Instead, the real question is what steps can be taken to address the issues revealed by the current crisis so as to improve the application of existing requirements and enhance current practices. Let me identify two areas for possible enhancement. The first issue relates to the narrow question of how to evaluate assets which a bank determines to be impaired on a more permanent basis. To use accounting terms, these are known as assets that are other than temporarily impaired, or OTTI. For most banks, especially community banks, OTTI is the main issue as it relates to fair value measurement. If a bank determines that impairment of one of its assets is other than temporary, the value of the asset on its balance sheet is written down to fair value, with the amount of the write-down reducing current earnings and therefore regulatory capital. Many commenters have described the dramatic effect such action can have on banks and other firms, and have raised legitimate questions about the appropriateness of the current application of fair value principles in this area. As I describe in more detail in my written statement, alternative OTTI models are currently being discussed to address this issue. We believe that such enhancements warrant active consideration by standard setters, and we are prepared to assist in that process in any way we can. Second issue relates to the broader question of how to value financial instruments for which there is no active liquid market. There is a clear need for additional guidance to address the numerous definitional and implementation questions that have surfaced in recent months. Such guidance would facilitate improvements in the relevance and reliability of valuations and benefit financial reporting, regulatory capital, and risk management. Mr. Chairman, as you noted in statements prior to this hearing, fair-minded, incremental, and achievable fixes to the issues with fair value accounting identified in recent months are clearly needed. This hearing is an important step in that direction, and I look forward to answering your questions.
Thank you very much, Mr. Bailey. Thank you all for your testimony. I guess I have something to confess. And Mr. Hertz, you know, I've been a regular participant in your yearly visits to my office and discussing FASB. And I've been sympathetic to getting a more transparent system of accounting so that it can be properly protective of investors. But I would make a comment, particularly in the financial service field. We don't have any investors anymore. The only investors we have are sitting out here and watching this on television. They're the taxpayers of the United States. And they're sort of saying to us, and you heard the comments of this committee, hey, this is our money, and every time a rule in accounting that drives down an asset and requires more regulatory capital, that capital is coming from the Treasury or the Federal Reserve backed by the taxpayers of the United States. Why wouldn't it be better to find a methodology that we wouldn't have to make those immediate transfusions, if you will. That's what we're talking about. Now, it was interesting, I'm getting more positive on the attitude that I hear something happening. As a matter of fact, after this panel is finished, so that you can listen to the next panel, I think we should put a room aside, conference room, and put you all in there with a deadline in 3 hours to work out the conclusions of what should be done. And I want to say that, obviously not that we can do it that quickly, but we can't waste time. I think you've heard the panel. I think you've heard the members almost to a person indicate that one way or another we're going to find a way to give some relief to the assessment of these assets. And we don't want to play regulators, standard setters. It's not our role. But we want you to do it. And, you know, I was for and supported, as you know, the FASB rule in terms of providing for the protection of market to market and what it would do. But that was before December 7th. Oh, I'm sorry, not December 7th, September 15th. You know, that's what happened. Nothing's going back anymore to pre-September 15th, just as in 1941, nothing went back to what existed in the world prior to December 7th. I think Warren Buffett's quite correct. And I was impressed. This morning I did an interview on CNBC. And immediately before my interview, they did the national news. And it was such a welcome statement that was made. They said that there's an ongoing third-stage study to cure pancreatic cancer, and that the success of the study was so great that they decided to suspend. The FDA is going to suspend the study and make the treatment available to everyone who suffers from pancreatic cancer. That is not normal for FDA or bureaucracy to act that relevantly to the need of the population. But I think it's something that our agencies, the SEC and FASB, should model after. We're now at the stage where we have people critical that don't have to suffer or don't have to die because of this rule if we can find a margin to bring that within conditions. So I think I speak for the whole committee on both sides. You know, I'd have to say, you've unified our committee, and that's not notorious in Congress, but you really brought about the strongest bipartisanship I've seen in a number of years, and everybody is agreeable to that, I think, on all sides. So you have accomplished something. Now we don't want you to unify and make us all bipartisan. We want you to act, and I think the message has to be just that clear. And what I'm worried about at this point, let me center it on both Mr. Crocker and Mr. Hertz. I still hear a little tinge in your testimony that somebody else has to do something, or either FASB has to do something before SEC does it, or SEC has to do something before FASB. Can we say that that is no longer applicable, that concept, and that now you're going to take it upon yourselves to do something, and even to do something that isn't common in this city? Pick up the telephone and communicate directly with one another. Don't be passing a lot of paper back and forth. That can follow the conclusion. But if we can get you either in the same room or on the same communication by telephone or otherwise, I really believe that this is a solvable problem. The people on the extremes, that is the purists who are in favor of mark-to-market, they're not going to be happy. The people on the other side that want us to do totally away with the rule and protecting transparency for investors, they're not going to be happy. But we may help save the jobs of several million Americans and keep the whole country out of a worse economic situation than what we presently see coming or potentially coming. So I'm not going to ask a particular question because I want to give the rest of the panel the opportunity to ask questions. I just wanted to impart to you, unusually, I am trying to bring to your attention the fact that this subcommittee, and I think the full committee, are prepared to act expeditiously. but we will not act until after we hear some testimony as to how soon. Maybe I can ask, I've got 30 seconds left. Could either of the two of you give us some indication of how long you think this problem could be resolved?
I'm happy to start. We have a commitment from the FASB, particularly as it relates to illiquid securities, and they've announced this, to act in a matter of weeks, not months. We work constructively with them daily, and our office stands fully ready to address the issues in our study. We prefer that the FASB work through that. We stand fully ready to assist the Commission in any way in implementing the actions in our study.
Mr. Hertz?
Yeah, as Mr. Croker said, we have announced a number of actions which are detailed in my testimony around more guidance on valuing inactive and illiquid markets, again trying to emphasize the need for good judgment. That's been one of the kind of frustrating issues in this, because, as I said, the standard tells you not to look to distressed sales or forced liquidations. It asks you to get a lot of data. If, in many cases, in these kind of conditions, what you ought to be doing is doing cash flow projections, which I think Representative Biggert and Mr. Campbell did, yet somehow the way it's being implemented is kind of on a last trade basis. And that's not the intent. The intent is to try to get a reasonable valuation. And so we're going to keep on putting more guidance out there. I don't know whether at some point we're just basically going to have to say, you know, for certain situations, do not use a market-based fair value, just do cash flow projections, and then we have to tell people guidance on that and what you would do in terms of a discount rate.
Are you going to be a little more clear in the message you send, or?
We hope so. We've been trying to.
You do understand the message that we're sending?
I absolutely do, sir.
Okay, Mr. Hertz, thank you very much. We'll now hear from the ranking member, Mr. Garrett.
Thank you, and I begin by associating myself with Mr. Campbell's comments with regard to how we got here, and it was not all due to accounting issues and what have you, and to Mr. Hertz's comments to that extent as well. I don't believe, though, that we got an answer from you, Mr. Hertz, as far as a timeline, although I think that's going to be the question my constituents are going to ask after this hearing. I'll give you just keep this in perspective. This administration believes that it, through Congress, can rewrite the entire financial structure in this entire country in the next 6 weeks before they go to the G20. If they can do that in the next 6 weeks, that's what they tell us, can you do this within the next 3 weeks?
We will have a proposal out during that time period.
There you go. I appreciate that.
Yeah.
And speaking of timelines, Mr. Bailey, I agree with Mr. Hertz that a portion of this should be looked at from the accounting aspect, but sure seems like a portion of this needs to be looked at from the regulatory side as well. What sort of time frame are we looking at there to accomplish that?
I think that's a very important question, and I think it's clear that any regulatory regime that is risk sensitive is cyclical in that it reflects the broader economy. I think the issue, which is the issue that Chairman Bernanke raised this week, is whether there is evidence that the regulatory capital rules and accounting standards are pro-cyclical and that they serve to amplify existing business cycles. This is an issue that the OCC and, frankly, domestic and international bank supervisors have taken very seriously. And in fact, the Basel Committee on Banking Supervision had issued in January a proposal that, among its provisions, would try to address some of the pro-cyclicality inherent in this process. Well, it's a comment that is open for comment right now, and I think the comment period ends later this quarter. One other thing that I want to highlight.
So the end of the game, because if obviously one of those banks that they're describing over here, they're saying the comment period's the end of this quarter, so then it gets through the next quarter, so we could go 2 or 3 quarters before the banks actually get good words from you guys?
I mean, if in fact there is, what we try to do, as I noted in my statement, that in most cases our regulatory capital regime tries to incorporate and reference GAAP provisions. If there are provisions changes in GAAP, the effect on capital would be immediate.
Okay. You mentioned, Chairman Bernanke, under TALF, Chairman says that assets that investors own will be held in a non-mark-to-market account. If that's the case, what is the Fed saying, and I'll throw this out to all of you with regard to the Fed's view of mark-to-market, since they're asking that these assets not be assessed or evaluated in that manner. Mr. Kroger.
I think that's consistent with the model that we have today for assets that aren't held for trading purposes. That is, we have available for sale, which isn't marked to market, and we have held to maturity. But I think that highlights the problem of other than temporary impairment, so that when there is a decline in cash flows, expected cash flows, there's a credit loss that is recognized, but then it's recognized on a fair value basis that includes all of the issues about liquidity. It's one of the issues that we believe needs to be readdressed. That is the accounting for impairments, and needs to be addressed timely.
The rest of you, for the record, are nodding your head yes in agreement with that. And while you can answer that question, you can also answer the question for me so I can understand this better. What's the ability then for an institution to move it from one bucket to the other bucket? And won't the pressure to be to move once everything gets better, because everything's going to get better in this economy, because we just did the stimulus, we're going to do another stimulus now, the economy's going to be great in a year from now, won't they be coming back to us and say we want to move it from one bucket to the other bucket? It's no longer going to be held for long-term purposes.
Yeah, that's a very good observation. You can move from one bucket to another, but if you move into held to maturity, which you can do, it then has to be held to maturity, subject to a few things. You can sell it if there's credit deterioration. You can sell it if the regulator says sell it, but otherwise you have to hold it and collect the cash flows.
Now, Europe has allowed this one-time shot deal to change that, right?
They did it to conform with our rules. They did it in October, retroactive to July 1st, but to conform with our rules.
So does that, can you explain that in 10 seconds?
Yeah. In their rules, International Financial Reporting Standards, IFRS, did not explicitly address the issue of whether you can transfer from one category to another. We in the U.S., we like lots of details. So we have rules relating to that and specifically allow transfers. But when you transfer from either trading or available for sale into held to maturity, there are constraints around held to maturity saying you really do have to hold it to maturity.
And I won't ask a question, but that goes back to what Mr. Bailey and the other regulators then might be doing 6 months from now or a year from now, right? Okay.
Thank you very much, Mr. Garrett. We'll now hear from the chairman of the full committee, Mr. Frank of Massachusetts.
The chairman of the subcommittee correctly said there's a very strong consensus there. I will tell you that as I walk around the Capitol, increasingly trying to avoid conversation with people, I am most often ambushed by people who want to complain about mark-to-market. So I have a personal interest in your resolving this. But the chairman is right when he talks about the consensus. I would say I'm also pleased that we do have a consensus. Let's be clear. There is no significant support for abolishing mark-to-market. There needs to be some form of valuation. We all understand that. And we also agree that there is a very important function here of information to investors. And there is no question. We have got investors scared out. That's why I think one of our major jobs is to give investors confidence. I hope by the end of the year we will, and even as we talk about regulation, we are talking about giving the investors more confidence. But that does leave us two areas where I think there also seems to be consensus. Mr. Hurst, I was pleased in your statement, pages 9 and 10, you quote Mr. Bernanke. You quote his earlier speech, of course he made a more recent one. And you're right, you quote him, but you say, I think the accounting authorities have a great deal of work to do to try to figure out how to deal with some of these assets which are not traded, but I don't see a suspension of the whole system. So that is both an affirmation of the need for continuation of mark-to-market as the framework, but an acknowledgement that we have to do two things. So there were two things. You have to work on what you're doing. Let me ask one question, because I think this is very important on the whole question of the buckets. You say if you put it into hold to maturity, you have to do it. What would the penalty be? Who penalized? Was SEC penalized or the OCC? If someone appeared to be manipulating, they put it in the sell to maturity bucket and then they prematurely matured, what would the penalty be?
The guidance that they have on, and this is out of FASB standards, requires you to hold it to maturity, and the penalty is that your assertion about other assets that you're holding to maturity is no longer recognized.
Okay, good. So there is a real,
Yep.
there is a real bite to that. I think that's important. I thought the gentleman from Jersey's question was important. Let me then talk about what's clearly within our jurisdiction. And I address here the OCC and the absent regulators as well. And I think we all are clear. And FASB says this. Their job is to get the accounting right. Yes, it's important to do that. And accounting is not an exact science. And I think there is a consensus that we can do a better job of differentiating. But it is also very important that we have a recognition of consequences. One of my former colleagues is in the room today who was here when we did the savings and loan and subsequent, and we toughened up the rules. So it may well be that in reaction to the last crisis, appropriately 18, 19 years ago, we diminished discretion that maybe now you want to have back. So I really want to make a very specific request. I make this as chairman of the committee, but I think in full cooperation with almost all, or maybe all the members of the committee. I really want you now to tell us, you need to volunteer, and we're asking you, so you don't have to clear this with OMB or anybody else. We want to know what legislative changes would we have to make to give you full discretion in how you react to the mark-to-market. I think that is absolutely essential. And as they are doing that, and I would ask, and I think I speak for the whole committee when I say we want to know those things. We may not want you to exercise it. There may be other differences. But to the extent that there are any legislative mandates which ought to be made a little more flexible, I now ask officially that you and the others who are paying attention send them to us. And I think those two things in parallel will do a great deal to be helpful. I don't know if anybody wants to comment on anything of what I've said. But,
Mr. Chairman, I think we'd be happy to provide that information. I think we, as an initial matter, I think there is significant discretion on the part of the supervisors to look at and adopt those portions of GAAP or not to.
Right.
That are inconsistent with our prudential safety and soundness.
Yeah, but I mean, here, let me put it. To the extent that there is a diminution in the capital because of a mark-to-market in some ways, I assume you now have to treat that all the same. It seems to me a diminution in capital because people have been really stupid and irresponsible is different than if there was a diminution in capital that occurred from a mark-to-market. Do you have the discretion to differentiate there in terms of what the institutions allowed to lend and what their capital requirements are?
Yeah, Mr. Chairman, as I noted in my written statement, I think what we try to do in regulatory capital is try to neutralize some of the temporary fluctuations.
So the answer is you do have that
Yes, we do.
flexibility. All right. Let me just say this in closing. I understand that. But I want to be clear. No agency, I hope, 2 months from now, is going to tell us that they would have liked to have shown more flexibility, but they couldn't because of a statutory obstacle. Because you have our assurance that we are ready to remove those excessive statutory obstacles. So this is the period. And, you know, if you think you have the discretion, you're not sure, there's one thing I've learned about in legislating. Redundancy is preferable to ambiguity. Don't worry about redundancy. A lot of us are lawyers. We have belts and suspenders and lewd and lascivious and et cetera, et cetera. We always like to say things twice, as you've noted from the questions. So please err on the side of making sure that you have all the discretionary authority you need. Thank you, Mr. Chairman.
Thank you very much, Mr. Frank. And now we'll hear from the ranking member of the full committee, Mr. Bacchus.
Thank you, Mr. Chairman. Let me say this to the panel. When I first started making inquiries as to mark-to-market and the distortions in the market, the first reaction I had from many at the SEC and FASB and in the accounting industry was this guy doesn't know fish buckets from accounting buckets, and he doesn't know bed sheets from spreadsheets. There was some truth in that. Started to say a lot of truth. But I had been hearing from bankers, I'd been hearing from lenders, and I'd actually been hearing from bank regulators, both state and federal, that there was a real problem. I requested this hearing October the 3rd. Now, that was not some coincidental date. That was the date that I received the letter from Robert Denham, your former boss, Mr. Hurst, which basically, as far as I read it, told me to butt out. He basically said, you know, we don't need any political interference. That was also the same day we passed TARP. And the reason for his letter, among other things, was that Roy Blunt and I included, legislation in the TARP that said study mark to market and determine whether it is distorting valuations or loan provisioning. We also troubled by when there's an acquisition, a purchase accounting. As a result of kind of a back and forth, the Washington Post on October the 28th, quoting accountants, basically said, don't blame mark-to-market accounting. I never have. I never have. I'm not blaming it. And I know the chairman of the subcommittee said it's not the cause of the crisis. No one thinks it is. But a lot of us think that its application in certain respects has worsened it. Not only us, but Chairman Bernanke, Mr. Dugan, regulators, people I respect. Talked to the former CEO of a bank that was listed as one of the 10 safest. He's a former CEO. He says it's a real problem. You heard Ms. Bachman. What many members were advocating was suspending mark-to-market. I was not doing that. I told the Washington Post, and here's what he said. The guy, he tracked down. He tracked down the guy, like I'm in a cave and they're pulling me out. The guy who got that provision in the bill, Representative Spencer Backus, the ranking minority member, he told me he wasn't trying to politicize accounting. I'm not. It just says study it. It doesn't say study it, study to repeal it. It doesn't say do a study to suspend it. But the SEC studied it at our request, and they came back and said it's causing some real problems, and they kicked it to you. And there's been nothing done. In fact, from January to, over 2 months, I think December to February, it took 2 months for you to even announce y'all were going forward with the study. And now you're saying it's going to be 3 months. You've said, you've identified some problems, but it's going to be another 3 months. One of the things that disturbs me, and you can answer this, you keep saying that you're defending investors, people who want to buy stocks or banks or whatever, these assets. I understand that, but what about the investors that hold them? What about most Americans who hold those investments and are seeing them unduly diminished or distorted in value? I've discussed with members of your staff, and let me ask you this. I'm not in accounting, but I went back to an old accounting book, and it defines fair market value, which is what we're supposed to have, right? And it's not, it seems to be a little different than mark to market. I mean, y'all use them interchangeably, but they're not. And I'm glad you agree. It's fair market value accounting, which is what we're supposed to have, the price at which property would change hands between a willing buyer and a willing seller. Now, when you come in and put mark to market, and I'm not an enemy of mark to market, you're distorting, to me, the free market, because the free market is a willing buyer and a willing seller. And until you have that, you don't have a transaction. And I've really never had a satisfactory answer to that. Mark to market assumes that you don't have a buyer willing to offer intrinsic or real value, and or that you have a seller that's got to sell. If I put up my house today and I don't get an offer for a week, I don't have to sell. But mark to market would presume that I had to sell. If I got in my car and it wouldn't crank because the battery was dead, I wouldn't call folks over and say, buy this car. They'd say, well, I'd like to drive it around the block. Well, the battery's dead. I don't have to sell it, nor do I have to take it to an auction tomorrow and sell it at an auction. I'll just hold on to it. And that's what bankers tell me every day. But mark-to-market reduces their reserves and is causing them real problems and distortions. And here we are today. I talked about John Lewis's book. I'd invite you to read those 2 pages. I really would, because I want you to buy into this as an urgent situation. You knew that I was upset by Mr. Denham's letter, but I didn't respond back, going back at him and tell him we're going to do something. I requested this hearing in October. I requested again in January. And let me say this, Mr. Garrett. I've not given them 6 weeks. I first contacted you in July of last year. And since that time, a lot of my constituents have had loans called. A lot of the businesses, the people I represent, have gone under. I would never blame you. I would never blame the accounting industry. In fact, let me say this. Empower your accountants. Empower your accountants to value property even the way they would like to. Give them some flexibility. And in doing this, please remember, in my opinion, that mark-to-market, it really interferes with the free market, because the free market is a willing buyer and a willing seller. And until you have that, you shouldn't have a transaction. And when you assume or force a presumption of a transaction, you devalue property. You devalue assets. You devalue loans. And to the bank regulators, y'all been telling me for 4 or 5 months there were problems with. I've got a letter where we swapped a letter back in August where you said, it's really hard for us to get an acquiring bank to buy now because you have to write down the assets. I said, well, why don't you change the rules or go to the accounting board? Why don't you go to the SEC? Because that's cost taxpayers billions of dollars because that rule hadn't changed. And I mean, the regulators have said since July it's not the right way to do it. When one bank buys another bank, all the assets have to be written down.
Why do the rest of us have to?
We've all agreed for some months now that shouldn't happen, but it continues to happen, and taxpayers, sometimes a bank is not bought, it fails because of that obstacle. So, join us in this House. We're not trying to politicize accounting. We're not trying to suspend the rules. But I'm going to go back to what I've always thought. You don't have a willing buyer, you don't have a willing seller. That's what fair, isn't that the definition? The price at which property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, and both having knowledge of the relevant facts. That's basically what a lot of banks do. They're not going to sell. But what you're doing by some of this accounting thing, you're forcing them to write down their assets, which devalues their capital, sometimes causes a run on their stock, and then they have to sell. I appreciate it very much.
Thank you very much, Mr. Baucus. And now we'll hear from the gentleman from New York, Mr. Ackerman.
It's not that Mr. Baucus didn't make his point, but let me tell you what my problem is. If his car don't crank and he unloads it because it's a lemon, why do I have to mark my car down?
Would the gentleman yield, I would put a new battery in, or I wouldn't have to sell it because it won't crank.
Yeah, but that's not my point. My point is, if you did sell it, why have you now just established a market? And if someone else's wife runs off with the milkman and his job goes to India and he's having a bad day, Bucky, why is my house suddenly worth less? Or why do I have to raise more capital in order to keep it? I mean, that's the real problem that exists here. And let me say this. You have indeed unified the committee. Interesting phenomenon, a market that was supposed to be down today. Since we all got together, it seems to have peaked over 7,000. Ordinarily, that wouldn't be a big thing to celebrate, but this morning, you might say that. I'm trying to understand how this is going to work, because you seem to all agree that we're going to make a change, and that was going to be my question originally. Are you going to change? And it seems that you're going to make the change, but the real question is, it's like if you had a horrible situation and you wound up waiting for an ambulance, or you were waiting for the fire truck to show up. You only ask one question: when? And this issue, which is a huge issue with the public, and not just here in the halls of Congress. I hear more about this than anything else when I go back to my district when people talk about financial issues, mark to market. And it's not that it's controversial, meaning that there's two sides to the issue. Everybody says it has to change. The question is when. So could you, in this time frame that we're talking about, where my constituents think it should be minutes or days, and we're not talking months anymore, but we're talking weeks and maybe 3 weeks, could you walk us through the process so we all understand in the context of what Chairman Frank asked for? Also, is there anything that we have to do legislatively? What has to happen, and how quickly can this happen sequentially? Walk us through this process so we can tick off the days on a calendar and tell people that help is on its way.
Well, from our side, in terms of the additional guidance that I talked about, we will get that out probably early April. It'll be for comment for a very short time frame. And,
early April? So you're talking about you're not going to get that out for another 4 weeks before you even get that out?
Will the gentleman yield?
Absolutely, Mr. Chairman.
Mr. Hertz, I just want to tell you there are 3 pieces of legislation presently pending in the Congress, in the House. I guarantee you one of those pieces of legislation is going to become law before early April.
I think what the chairman said is, if you don't act, we will. The time frame that you're starting out with, thinking you have the luxury of that much space, is not acceptable, I don't believe, to the members of this committee on either side of the aisle. If you're going to act and we have to respond to what you're going to do, you got to get back real quick and let us know. So maybe you want to start the answer again.
Okay, I've heard you. I've heard you very clear. We will go back and we will consider exactly how.
Can you do this whole thing in the 3 weeks that was referenced before?
We probably could. It would mean.
Will you do this within 3 weeks?
I have to talk to the other members of my board.
When will you talk to them?
I will talk to them when I get back tonight.
Tonight?
Yes.
Mr. Croker, is that? With the right cooperation between the two of you, can you do this in 3 weeks?
We can absolutely work with the FASB in that time frame.
And get this within that time frame.
We expect within that time frame, and we, as I said in my testimony, we expect action within weeks, not months. The commission, the staff, my staff, stands ready to assist the commission in any way possible if we don't see that action.
So if the press wanted to report accurately, we could have this fixed in 3 weeks.
We could have the guidance in 3 weeks. Whether it would fix things is another question. I hope it will.
I'm not talking about the result out in the street, but I'm talking about fixing the problem in terms of what we've all been talking about. That can be done in it will be done in 3 weeks. Can and will.
Yes.
Can and will.
Yes.
Yield back the balance of my time.
The gentleman from Delaware, Governor Castle.
Thank you very much, Mr. Chairman. I want to go sort of behind the accounting on this a little bit and look at the assets that these financial institutions own and get your comments about that. Obviously, we're dealing in terms of what we have to do with the mark-to-market with illiquid, not active assets. And I don't know if either you or any principals in your agencies or your agencies in general have commented on those particular so-called assets, on whether or not the banks or the financial institutions should be holding them. And a related question is, is anything being done to set up a market for these assets? I mean, the real problem is that there is no market for it. They are illiquid, and they're not actively traded, and you sort of based it on some trade that may have happened weeks before or whatever it may be. So is any effort being made? Is there anything we could be doing or anybody could be doing to set up some sort of a better market that would give it true value? So instead of worrying about whether we have fair value or cost accounting, we actually can look at something and determine the value of it. So I'm interested in any comments that you know of and your agencies have been made concerning the particular assets and whether the financial institutions should even be holding them. And if they are going to hold them, what kind of marketing circumstances either are being set up or could be set up, or anything we could do to encourage that. And I would ask all of you to comment on that if you could, in any order.
With respect to whether these assets should be held by financial institutions, I'll defer to the banking regulators. And I think that's a policy issue within their purview. In terms of improvements to the markets, again, I'm in the Office of the Chief Accountant advising the Commission on Accounting and Auditing Policy Matters, but there are certainly steps in place to address the securitization market, improvements to the transparency and the disclosure. I'm happy to work with our Legislative Affairs Group to get back to you more fully on that question. Is outside my particular area of expertise.
Mr. Bailey?
Based on our understanding of the issues facing banks in valuations in illiquid markets, I think it is a pervasive issue. It may have much more relevance in certain contexts to complex financial instruments, but I don't think there is any issues we're aware of where there has been arguments that the banks don't have the legal ability to hold the asset. I think it is much more a reflection of the marketplace and some of the valuation challenges they've seen in dealing where there is no observable market, no observable inputs, and no active markets for trading. But again, we are not aware of that there are legal issues associated with the ability of banks to hold those assets.
Mr. Hertz?
I'd just like to observe that I think Chairman Bernanke was exactly right. This whole issue is an issue about how do you value very uncertain cash flows. And that's what it's all about here. And we've got uncertain cash flows for some of these things because they're inherently complex. They were, highly financially engineered, some of these things. There's not a lot of price discovery, as you've said. And there's considerable uncertainty about the underlying collateral. That is, the loans that back these securities as to what the economic trajectory is going to be. And then finally, there's uncertainty right now as to what the government's plans are in regard to purchasing those assets. So all of those combine to get a very thorny valuation problem. It's that's why part of the issue in giving guidance to people is so difficult. Other than say, get the facts and here's the objective and do your best.
Well, I appreciate your answers. And Mr. Bailey, I'm a little concerned about whether or not we should be looking at these investments. And they are, as was indicated, highly financially engineered. They're leveraged ought to beat heck, and they've led to a lot of problems. And I'm not too sure that the banking regulators should not be looking at that in some way or another.
No, we have certainly spent a lot of time looking at these complex instruments, and they're right. There is the valuation of the cash flows and the associated collateral does present a lot of challenges both to banks and supervisors. And we do spend a lot of time making certain that the valuation process banks use to make certain there is a realistic valuation of those assets is a particular focus of our supervisory program. And in fact, in my written statement, I do provide and cite two different documents that do provide to highlight some of the associated challenges on valuation for those complex instruments. And what we're trying to do in this context is trying to improve best practices within the industry about how to realistically value those complex instruments. And again, dealing with the issues identified today, dealing with the uncertain cash flows and the collateral issues. And again, but we are happy to engage in that discussion with you more fully to kind of make certain we these issues are being conveyed in a way that makes sense.
Can I also note that, as I did in my testimony, that loans, just whole loans, are not marked to market at all. Right. The accounting for that has nothing to do with either mark to market or fair value unless they are loans that are held for sale. Then there's a lower of cost or market approach. Property normally is not fair valued either. So what we're talking about here is a range of securities, particularly securitized assets that came out of CDOs and things like that.
Exactly. We're talking about fair value, something we don't know how to evaluate. It's the problem, basically. Thank you, gentlemen. I yield back, Mr. Chairman.
Thank you, Mr. Castle. The gentleman from Massachusetts, for 5 minutes, Mr. Capuano.
Thank you, Mr. Chairman. Chairman, I don't think I can improve on the questions you asked, and more importantly, the answers these gentlemen gave. 3 weeks sounds good to me. I actually think it's a little late, but I'll take what I can get. But I do want to take some time to talk about some of the comments that were made when accounting didn't cause the problem. I agree, didn't cause it, but it certainly was complicit in the problem. The SEC certainly was complicit in the problem. The OCC certainly was complicit in the problem by a lack of doing anything. Each one of you, just one item alone. SIVs. Nobody had anything to say about them. Everybody said they were perfectly fine. Take these special investment vehicles of regulated banks, take them off the books, don't count them, no big deal. Every one of them came back to bite us, and every one of your agencies were complicit in allowing that to happen. Okay, yesterday's news, but my hope is that in the next, not 3 weeks, but at least soon thereafter, those are gone forever. Forever. Accounting, not a problem. Fair market value, I like the concept. I totally agree we need to get to it. But I also know that right now, I'm not painting the house. The house is burning. And I've voted for things here that I don't normally like. I don't like some of the things the Fed is doing, but I know they're necessary in these times. I certainly don't like the federal government investing in private companies, but I know it's necessary at this time. We're out of the usual. We're out of the ordinary. This is not regular accounting issues. You wouldn't be here if they were. This is a crisis. We need you to help. I don't want Congress to do this. You don't want Congress to do this. Don't let us. This is not where we belong. Don't make us have to do this. And again, the comments to Mr. Ackerman in particular, the 3 weeks comment, are very good. Now, again, I'd like to see what you do in 3 weeks, and I hope we don't have to have you back here. But whatever you want to call it, suspend, adjust, amend, clarify. I mean, toxic assets became bad assets, and now they're legacy assets. Did any of you come up with that term? Because if you did, good job. Good job. At the same time, they're all the same things. What I want, probably I may be alone on this panel on this, I want, when you finish changing or amending or clarifying these rules, I want then our friends, the Treasury and the Fed, to use these new rules to avoid the whole concept of the bad bank. The idea of taxpayers taking these assets off the books should not be necessary if you allow thoughtful, reasonable, temporary accounting rules to keep them on the books of the people who took the risks, keep them off the back of the taxpayers. If you don't do that, my expectation is we'll have no choice but to take them off those books, and it is unnecessary. 2 of you represent taxpayers, 1 of you doesn't, but I'm sure you do represent taxpayers on the other side of the table. Do what you can for us, and again, you've already answered the questions I had with Mr. Ackerman. You know that you will be held accountable to them, and I look forward to what you provide us in that 3-week period. With that, Mr. Chairman, I yield back the balance of my time.
Thank you, Mr. Capuano. Ms. Price for 5 minutes.
Thank you, Mr. Chairman. I apologize, I had to step out, but I understand that Mr. Hertz, you said that within three weeks you'll be able to issue new guidelines. Is that correct? I'm over here.
That's what I'm going to go back and talk to my board members about. Remember, I am 1 vote of 5, but clearly I will take back your very clear message from today. But, I cannot,
right. Well,
myself do it. I have 4 other very conscientious board members.
Do we need to bring the other 4 in here?
I don't know.
Well,
I will talk with them. I'm sure they will. They may be watching right now. We will do everything that we can.
Well, let me follow up on that. I'm interested in a 3-week timeline. I think that's great. I'm over here, but I am more interested in what guidance is going to come out. The guidance that FASB has already given has not been helpful. Tell me what kind of guidance you believe you can give that will be helpful to my constituents and folks all across this nation who absolutely need a solution to this.
I believe that, and again, this is part of the frustration also on our part, because the fair value measurement approach has within it a ability to do cash flow modeling rather than just take prices in the market that might have been fire sales that you don't really know. We have told people repeatedly it is not a last trade model, particularly in these kinds of markets, yet for some reason we're told that keeps on happening.
Why do you believe that keeps happening?
Well, we're told that there's kind of institutional and cultural aspects in the system. One is that from the bank point of view, the preparer point of view, unfortunately, many of these institutions do not have the internal expertise to do the cash flow modeling of some of these complex items. And unfortunately, because there was no market infrastructure set up around these things and periodic reporting like we have for corporate bonds and corporate stocks, there's not standardized information always readily
So the examiners are more strict than they otherwise need to be.
No, I don't think it's the examiner. I think the preparers don't necessarily have the expertise and may not want to have to pay for an outside valuation person.
Well, the word that we get from back home is that the examiners are remarkably strict and want absolutely every I dotted and T crossed, and consequently, I believe that guidance ought to be more specific for the institutions that you're looking at, so they know what the rules are. Right now, they don't know what the rules are.
Well, I think they can. I think the rules are pretty clear, but we're going to have to give them some more examples. For example,
with all due respect, if the rules were clear, then you would be able to be fully culpable for what's happening, because what's happening isn't working. Correct?
The rules. As I said, there's a second factor that I also wanted to talk about. Is you talked about the examiners. I mean, the anecdotal feedback we get also is that there's a little bit of bias in the auditing system to look for trades rather than to do the cash flow modeling. And I don't know. And the SEC study, their data was as of the third quarter of last year, but seems to back that up a little bit. Either that or there are trades going on. Now, I do know that for example, one major financial institution very recently decided to reposition itself and get out of a lot of these things, and did it in an orderly way, but at very low prices. Very low prices.
My time's about to run out, but I want to get to one other issue, and that is that we hear that that mark-to-market protects investors. Tell me, other than short traders, how does mark-to-market protect investors, especially on mortgage-backed securities that are going to be held to maturity, performing?
Well, the securities may be held, but investors are buying and selling every day. Their decisions are not held to maturity decisions.
The investors right now are getting killed on this stuff.
They're getting killed because the values are very low.
And the values, is it not true that the values are low because of the accounting rules that are being enforced right now by FASB and others?
That's a matter of whether you think those values are realistic or not. I do have some concerns again about this last trade phenomena, which is not the intent of the standard. I would also say, however, that loan accounting, and I think all the supervisors agree with this nationally and internationally, loans are overstated on companies' books.
Mr. Chairman, my time's expired, but I would appreciate it if we might be able to get from FASB and others the specific guidelines that you are considering that you believe will allow that greater flexibility.
We have an agreement that you supply the members of the committee with that?
Immediately we prepare the proposal, we will send it to you.
Thank you very much, Mr. Hurst. Thank you.
Chairman, if I can make a 15-second comment.
Moment comment is recognized.
I think sometimes why accountants may be applying something, they're covering themselves. You know, and if you can give them, you know, and the regulators sometimes, examiners, they're covering themselves. But if you can give them some cover, if you can give them, you know, and you know, we do have lawsuits in this country, and and I think that's the fear of litigation, fear of you know, somebody coming back and saying you should have done it a different way. And you could give them some cover, you know, and a reasonable cover or flexibility.
Thank you very much, Mr. Baucus. Gentleman from Colorado, Mr. Perlmutter.
Thank you, Mr. Chairman. Gentlemen, appreciate your testimony. I understand the 3 weeks. I guess, again, I'm somebody who thinks we've studied this plenty, and I appreciate the SEC's, you know, voluminous study of this, but this is about discounted cash flows giving some kind of recognition to the value of these portfolios that's just not there in the market because it's illiquid. And it's caused a lot of damage and continues to cause a lot of damage by exaggerating this. And you know, everybody's been pounding on you, Mr. Hertz, but I'm looking at the regulators on either side of you, and I'm not happy. I think the mission of the SEC is not to really supervise the banking industry. So you have a narrower vision than what I think needs to be considered here. And I'm afraid on the banking side of this that the examiners aren't exercising the discretion that maybe or maybe not that they have. And the rapidity of the cycle that we've seen is something none of us could imagine. Now, on this committee, we have had so many hearings over the course of the last year that you know, it's obvious to us. And so time is of the essence, gentlemen. 3 weeks is too much, Mr. Hertz. I mean, I think you could do it now. You all know what's going on here. So let's just talk about an example that really was disturbing to me involving the Federal Home Loan Bank of Seattle. Just, you know, what I read in the newspaper, an anticipated loss of $12 million turns into a write-down of $300 million. And then it places whatever covenants they have with the regulatory community in jeopardy. So, Mr. Bailey, how does that happen?
As I understand the example, what you had in that situation, and again, this is going from memory, that you had an asset that the company deemed to be impaired on an other than temporary basis, and therefore had to fair value the asset based upon existing markets and in the marketplaces we discussed just a minute ago, and reflect that change in fair value in earnings. One of the issues that we have identified this is one of the issues we've identified that is certainly worth additional scrutiny. And in fact, in my written statement, I do provide this as the example. One of the things that has been identified, frankly, in the SEC study, and it was echoed by a letter from the Center for Audit Quality, is whether, in fact, there should be a possible enhancements to the OTTI model to address this very issue, to try to differentiate between the credit-related impairment and the non-credit-related impairment in determining what is the proper accounting. And in that context, and one of the ideas being circulated, is that the credit-related impairment would continue to go to earnings, but the non-credit-related impairment that reflects much of the liquidity discount that we've talked about today would not go in earnings, but would go in OCI.
All right.
And from our standpoint, therefore, would not affect capital.
Okay. And Mr. Lucas from Oklahoma, Mr. Donnelly from Indiana, Mr. Green from Texas, and I have a bill to try to give you guys the discretion or create a board that is looking beyond just the SEC's vision of investors, which I credit them. That's their job. You guys have a broader job. Everybody needs to be looking at the whole field, because what's happening to us, and you've heard it from virtually every member that's spoken, is as this credit as the capital collapses, the credit on a leverage basis comes in at 10 times or more. So $50,000 needed for capital, nobody's investing right now, $500,000 in loans called. And in Colorado, businesses then can't renew lines of credit, and people are laid off. And we are just, so between the credit side of this thing and then the job layoff side of this thing, it's getting worse and worse. Now, we can turn this around, and I think we are, but you have to move on this thing. We can't study it anymore. Mr. Hertz, I understand that. Frankly, I think it needs to be a broader view than the SEC in determining how these accounting standards apply to the banking sector, because the banks have a different role in a vast way, and we've spent $700 billion plus to try to keep the banks in moving, so lubricates this economy and credit is extended and we don't lay people off. And it's happened overnight. I mean, it is resting on your shoulders. It doesn't start with you, but I'll tell you, this is exacerbating it. And with that, Mr. Chairman, I'll yield back.
Thank you very much, Mr. Perlmutter. And now the gentlelady from Illinois, Mrs. Biggert.
Thank you, Mr. Chairman. And my question is for Mr. Coker. In the SEC study on fair value, the report indicated that credit impairment could be reported separately from impairments due to other factors on the income statement and on the balance sheet. Do you think that this alternative could benefit investors and the marketplace in general?
We had a lot of input in the study on a model that would separate the credit, just exactly what Mr. Bailey was talking about, the credit aspects of impairment from the liquidity or the other components. And I think if this displayed properly, we can keep the same amount of information while showing the illiquid piece of the impairment somewhere else other than the income statement. I think that can be done. We've heard challenges that banks may face in separating the two, but I don't think that should at all detract us from moving forward on that idea.
How would that benefit then the investors and the marketplace?
I think the investors would still have the information about both the current value of that of the asset. They would also then have a better understanding of management's view of the underlying cash flows. That is, how much is credit impaired and how much of that decline in value may relate to other factors.
And then, are you aware of any efforts underway to implement something like this?
This is something that we are looking at together with the International Accounting Standards Board. Because if we change our model, the advice we've gotten, from the G20, from the Financial Stability Forum, is if you're going to radically change the existing model, make sure that it's done on a uniform international basis. Because what happens is all sorts of versions of accounting arbitrage start to happen when we've got different rules in one jurisdiction versus another. So that is specifically one of the things we're looking at in that effort.
Well, I think we certainly have to do something, and you haven't been moving on your guidance. So, Mr. Croker, can you give us a commitment to repair OTTI by the end of this quarter? Your letter of October 2008 requested that FASB repair this expeditiously, and that was October of 2008.
I can give you a commitment that my staff will work as diligently as possible to assist the Commission in. I cannot commit the commissioners, but my staff will stand ready to commit or to assist in any way necessary.
One of the specific aspects of that was in the SEC report related to some inconsistencies in the OTTI rules related to securitized assets, which is particularly the problem area we're talking about. We dealt with that in January.
And you've come out with that in writing?
Yep. We issued something already.
Okay. Could you send that to us, please? All right. But, this seems the problem is that, we really have to, and going back to Mr. Ackerman's question, that you talk about the guidance. I don't know if you then agree with this other proposal,
I personally do not. I agree with going to my personal model of what financial instruments ought to be accounted for, is that if you're going to trade them or sell them, they ought to be at a mark-to-market basis. If you're going to hold them for cash collection, they ought to be on a discounted cash flow basis.
Well, don't you think that we need to use all the tools to address this issue squarely and in a assuredly meaningful way? It seems like we're just going on and on and on. You know, when Paulson came to us and said that the whole economics industry or in the economy was going to crash if we didn't act immediately. Now, maybe we didn't get it right in all aspects, but we really tried to do something. And we just have you come in and, okay, we'll do it now, and we're just not seeing it.
We and it's reflected in the SEC study, and we held a lot of public roundtables, and the views that you will hear from bankers and their trade groups is not necessarily the views you will hear from investors. And they have urged us not to weaken the current rules. Now, providing better guidance to get the rules applied in the way we intended is what we're trying to do in this very fast period.
Well, this is a real hot potato, and I think that you mentioned taking some action, but I don't think it's enough. And maybe you have good intentions, but they haven't resulted in an adequate response. And so I think there's more that you can do, and can do it much faster. And I would appreciate that if it happens. So
I'm going to tell people here on public television that the rules the standard allows for the exercise of appropriate judgment. I'm going to say that. I'm going to say it again. Yet it's not it cannot, with illiquid markets and complex securities, be a mechanical exercise.
Well, we hear a lot about how complicated it is, but please move ahead.
Thank you very much, Ms. Baker. And now we'll hear from the gentlelady from Ohio, Ms. Kepner.
First of all, I want to thank Chairman Kanjorski for holding this hearing and allowing me the courtesy to sit in. I used to serve on this committee and have not for several years, but I think this is the most important hearing that this Congress has held in this new Congress. And I want to commend the gentleman for his leadership. I want to commend the members who are here. Mr. Perlmutter for the legislation that he's offered, Mr. Backus, who's been a strong voice on this, Mr. Campbell, Ms. Biggert, Mr. Manzullo. It's interesting who's in the room. This is a rather difficult area for the general public to understand, but what is happening in our economy, I assume the people here gathered understand its significance. It's too bad all of America doesn't understand how important this is. So I really want to thank, and I can't thank Chairman Kanjorski enough for his leadership and his knowledge. You are definitely the right man in the right place at the right time. And I wanted to put that on the record first. Number two, I want to say that when I served on this committee, I fought against what has happened to our real estate finance market, and I lost. And they told us back then that after what happened with the Resolution Trust Corporation and all that debt that was put on the American people, $150 billion worth financed through our grandchildren, we'd never have another real estate problem in finance because they were going to securitize it. And then, Congresswoman, you don't really understand, we'll never have another real estate implosion. And people who'd spent their life in housing said, they're booms and busts. And you in the commercial banking world, and you investors, you don't understand real estate. Oh, no, Congresswoman, we understand housing. We can do it. I remember those days here. And then we moved into interstate banking, and these institutions got bigger and more irresponsible and lacked prudence, and they destroyed our community banks, our thrifts, the prudent lending, where character, collateral, and collectability had been the standard, to Wall Street gambling. That's the way I look at it. So, Mr. Hirsch, you got a difficult job. You got a real difficult job. But what I can tell you is that in communities like mine, I've told my people to squat in their houses to get a lawyer because we've had 10% of our homes foreclosed And if something doesn't happen, 20%. And now people are losing their jobs by the scores because the whole credit markets are frozen. And now they're losing their homes because they don't have jobs. So this thing is just snowballing to a point that none of us want to happen. For the life of me, I cannot understand why last year Secretary Paulson did not suspend mark-to-market. To have this kind of a conversation, maybe it happened and nobody knew about it, but we have destroyed more capital inside our financial system through mark-to-market than we've been able to pour in at the top through taxpayer dollars. And every day the hole gets deeper, so somehow your wisdom has to factor in. And I hope that whatever is done will re-empower eventually local lending like we used to know it, where the real estate market isn't relegated to a robo-dial system where somebody calls you and you want to refinance. You don't even know this character over on the other side of the country, and there is no prudence. There is no proper underwriting and appraisal. So you have a real knot to unwind here, but all I'm telling you is I agree with those who want some type of temporary quick action, because communities like mine, sir, gentlemen, they are falling off the edge. And this real estate issue and the valuation is absolutely critical. In places like Cleveland, and I don't even represent Cleveland, entire neighborhoods are now vacant. And I want to place on the record a story in the New York Times last Sunday regarding what is happening in Cleveland. So I have two quick questions, and I appreciate being able to say this today. Are you going to fix the OTTI by April 1st? You sort of answered that, but give us an absolute sense of that. And then I want to ask you, how do you think about the fact that over 2/3 or more of the credit instruments that were used to finance this real estate are not on the books of normal banking institutions? How do you deal with that from an accounting standpoint as you think about mark-to-market? Could you give us a sense of that? You can possibly fix the ones on the books of normal institutions, and we'll hear more in the next session from those who've actually accomplished it in past meltdowns in our real estate market. But how are you going to deal with the CDOs and the securitized debt obligations and the over-leveraging? Yes, Mr. Croker, and then Mr. Hertz.
With respect to the CDOs and the off-balance sheet accounting, it's an area that we identified at the SEC very early on. In fact, in January of 2008, sent a letter to the FASB because of concerns that we had with respect to needed and necessary improvement in off-balance sheet accounting. The FASB has exposed a document that would improve off-balance sheet accounting, is right now in the midst of redeliberation. And Bob, Mr. Hertz, I don't know your time frame, but
it should be finalized next month, but it would be effective next year. And a lot of people have concerns about that because although they agree with the notion, they don't want the idea of impeding the revival of the securitization market, which I take you, that wouldn't bother you, but the plan is to finalize it in April and effective January 1st, so that a lot of these things that are now in off-balance sheet vehicles would be on the books of the sponsoring entity, the bank.
in the meantime, you've added additional disclosure to address that exact issue, because there is a tension of putting assets on balance sheet and then the related regulatory capital impacts.
Mr. Bailey, you wanted to comment?
Yes, we've obviously had discussions with the standard setters and the SEC on the changes to FAS 140 and FIN 46R, which is being referred to here. And clearly that will have, depending upon the nature of the changes, a significant effect on bank capital ratios. Because again, essentially what you're bringing is you're dealing with off-balance sheet activities, bringing on balance sheet. And the issue is, what is the regulatory capital consequence of bringing those activities back on balance sheet? And that's an issue, again, that, we provided comments on earlier discussions of these changes, and I think we're most anxious to understand what these proposals are going to be And frankly, then we were going to have to determine the regulatory capital effect of this change in GAAP.
And I didn't hear a clear answer, Mr. Chairman. Will you fix the OTTI, following on Mrs. Bigger's question, by April 1st?
The OTTI issue, as I said in January, we issued something that dealt specifically with other than temporary impairment for securitized assets, which was a thing mentioned in the SEC report.
But are you saying that that's applicable by April 1st?
That's applicable now. It was applicable at year end.
All right. Thank you, Mr. Chairman.
Thank you very much. And now we'll hear from Mr. Campbell for 5 minutes.
Thank you, Mr. Chairman. I want to go to these buckets things that we're talking about. Now, if I'm a bank, I'm a financial institution, and I tell you that this bunch of mortgages, mortgage-backed securities, whatever, that I'm intending to sell it. So you want to value it one way, potentially value it one way. And then I change my mind because I don't like the market that's out there and I don't like the price I'm getting. So you know what, I'm going to hold it for a while. I guess the question I have is a problem I'm having with these are things which held to maturity means potentially 30 years, certainly at least 10. Somebody can change their minds in that time and not trying to manipulate the accounting rules or the regulatory process. How do you deal with that, or why is that? Why do you get punished for that? Or
the standard that was developed, this is standard number 115, which was developed after the S&L crisis. It has the 3 buckets, and there's a lot of flexibility. There's more flexibility of going into trading or into available for sale. But once you go into held to maturity, you're kind of chained in unless the regulator tells you have to sell, or you can sell if there's a credit deterioration and a few other things. But it's basically that. And I think the thinking at that time was when you're in held to maturity, you're at cost subject to other than temporary impairment. The thinking at that time was really, at that time, the SEC at that time and the FASB at that time really believed that everything should be at fair value, and the not having something at fair value ought to be tightly restricted.
Okay, and as you suggested, perhaps in normal times, net present cash flow, expected cash flow, would be the same as what you would achieve in the marketplace. But that's clearly not the case today. And I guess the problem I'm having is that, and I understand the complications with getting the net present value cash flow, but that is a number which, if you look at what's happened, it would be declining on an orderly basis for the value of most of these assets. And if an institution decides that, all right, we're going to unload this thing now for whatever reason, we need the capital, whatever it may be, we need the cash, whatever, then they'll have a loss, and they'll take a big loss on their in a fairly short-term fashion. I guess what's wrong with that kind of approach?
It's again, everything gets to the issue of uncertain streams of cash flows in these instruments. And there are ranges of cash flows. And the market prices of these, people don't like them, but they take into account the ranges and the degree of uncertainty around those ranges. And that's why you get, the illiquidity is also part of that factor, is the inability to put the credit problem in a box. And so that's why the prices are very, very low, because of the whole uncertainty around the ranges of future cash flows in these things and in this whole economy.
Are you looking at all at any of those 3 boxes in your review? Are you looking at?
Well, we're looking with the International Accounting Standards Board to completely revise this model, but we want to do it on an international basis, so that what we do in the U.S. would be the same as in Europe, as in Japan, across all the institutions, and that's what we've been asked to do by the G20, by the Financial Stability Forum, by the SEC. Not just if we're going to do a major revamp, we should not just do it U.S. only.
Okay, so even if in 3 weeks you come out with a proposal,
proposal in 3 weeks is more guidance on using the existing model.
Okay, because what you're talking about would take some time.
Oh, it will take more than a year.
Okay.
On an international, anybody
All
who
right,
works on an international basis will appreciate that.
I'll just in my final moments here make a comment, which is what we do not want here. I think what you don't want, what all of you shouldn't want, is for us to set accounting rules. We do not want to politicize the fair valuation and the fair statement of accounting and what experts believe is the best form of presentation to determine the fair value of a company or an asset or whatever it is. We really don't want that. And the best way to avoid that is to act expeditiously and clearly cautiously, but expeditiously, so that we don't ever want to go down the road of politicizing the value, the accounting rules or the accounting value of companies. That's not good for anybody anywhere. So thank you very much. Thank you, Mr. Chairman.
Thank you very much, Mr. Campbell. And now we'll hear from Mr. Donnelly.
Thank you, Mr. Chairman, and I apologize. I had to step out for a meeting. But to give you a little background, in my district right now, in Elkhart County, where the President visited, unemployment is 18.3% as of right now. And the main culprit is a complete lack of credit for the products, for the companies, for floor plan financing. And the financial institutions are telling us we can't lend, and we can't lend in large part because of mark-to-market. And so this is not an academic exercise for the people who live in my area. This is a dad or a mom who lost their job because the product's not being built, because people who went to get financing for the product can't get financing. And so to us, this is food on the table. And when assets that are not intended to be sold for 15 to 20 years and do have some predictable income stream are valued at such a low figure, it goes to more than just accounting class. It goes to families who are now going to food pantries. And so this is very, very real to us. And I wanted to ask Mr. Crocker, what can be done to improve the accuracy in determining the risk of these products to come to a fairer valuation in your judgment?
I think we talked about a number of...
And I apologize if you talked a little bit about this. I'm sorry.
A number have been talked about, but I think partly it's emphasizing and clarifying the objective of fair value, and that is it isn't to peg assets to distressed sales. It isn't to look at the last trade that was a fire sale and mark your asset to that value. It is how to, I think the guidance, the improvements need to focus on how in illiquid markets, when you have distressed sales, how do you come to a reasonable assessment of what a willing buyer and willing seller would transact at? How do you use the cash flows to do that?
And there's no desire to do a rush to judgment, but we don't have the luxury right now to sit here and for the next couple of years argue about mark-to-market, because it went up 2 points in the last month, from 16.3 to 18.3. And I did a conference call yesterday with the companies, and one CEO after another, we just can't get credit, Joe. That's what they told me. And the financial institutions who were there, who used to provide credit, said credit is frozen, mark-to-market is absolutely killing us. And so I'm a proud co-sponsor of Mr. Perlmutter's bill, because we just don't have the time anymore. We've been at this for 6 months, and I respect your bona fides, but it's the real deal for us. And Mr. Chairman, thank you for your time.
Thank you very much, Mr. Donnelly. And now we'll hear from Mr. Lucas for 5 minutes.
Thank you, Mr. Chairman. Gentlemen, a study by Paul Volcker of the Group of 30, for them I should say, of the Group of 30, said that mark-to-market accounting was, if anything, pro-cyclical, that it exacerbates the ups and the downs. Would you agree with that? Does the system we use now presently exaggerate values in good times as well as slam things down disproportionately in bad times?
I personally believe that anytime you report current news and, mark to market is you get your 401k statement or your investment account statement. It's on a fair value basis. It shows the current values of your investments. If they're going up, you feel real good. There's a wealth effect there. And if things are bad, you kind of pull in your horns. And that's the same with getting the employment information and all of that. I think it does have behavioral effects.
Mr. Bailey?
As Chairman Bernanke indicated earlier this week, there is clear evidence that there is pro-cyclical effects from a number of public policy initiatives, including accounting and capital. And I think one of the things, and I think that is a reality that the public policymakers have looked at and frankly have tried to deal with. For example, what the OCC and the SEC are actually co-chairs of a project from the Financial Stability Forum to address pro-cyclicality in current provisioning practices. There are other discussions in the Financial Stability Forum to deal with pro-cyclicality in capital and valuation and leverage. And many of those projects are expected to be discussed at the G20 summit in early April. And I think one of the efforts of these projects from the FSF is to explore the pro-cyclical effects of these various initiatives and to see what steps can be taken to mitigate those effects. And I think that has been an active issue. And again, we've worked closely with the SEC on the provisioning issue. That's something we have spent considerable time on over the last 6 months to try to mitigate this problem.
I would absolutely agree with that. And I think it is important to Mr. Bailey's point that there's actually a work stream looking at whether or not historical cost accounting, because many believe that loan accounting, which is done at historical cost, and the related impact of provisioning, and when you provide that bad news, is equally pro-cyclical. And so I think studying not only the fair value impact of that, and I think there are changes that we've talked about, and they need to be done in time frames that we've committed to, but bad news has a tendency to foster bad results.
Well, just remember, gentlemen, we all play by the rules in this economy that are laid out for us. You all are involved in a very key point of laying out the ground rules. The concern out in the countryside is that for a focus on the trees, so to speak, that you've missed the forest fire that's going on around us all. Ed and I, in the form of 1349, are trying in a responsible way to create a bill that will, a board that will bring in many more perspectives or more perspectives to help encourage thoughtful policy and help move thoughtful policy along a little bit quicker. We can't stand and let the forest burn totally to the ground, and you, by your actions in the coming days and months, doing what's prudent, what's proper, what's in line with your education, your background, and your experiences, can help fight this fire. So, Mr. Chairman, I encourage my colleagues to join Ed and I on 1349, encourage our friends at the table here to move diligently to do what they know to be the right thing, and yield back, sir.
Thank you very much, Mr. Lucas. And now we'll hear from Mr. Manzullo.
Thank you, Mr. Chairman. Do either of you three gentlemen have any background in manufacturing?
I do not.
Okay.
Audited manufacturing companies.
Pardon?
I was an auditor in my prior incarnation, and I audited manufacturing companies.
Okay, okay. Well, that would make sense. You're not a tool and die maker. You're a CPA by background. Is that correct? And I appreciate that. So you know what goes on in manufacturing. The problems that we see is and Mrs. Capter and I are, we spend a lot of time on manufacturing. I probably have 2,000 factories in our congressional district, is that the standard that's used to evaluate securities is also used to evaluate the assets that are used for a loan at a bank. It bleeds all the way through. And industry after industry after industry, and Mrs. Capter could tell you the same story, comes to us desperate. Manufacturing companies that have never missed a payment, that have assets 7, 8, 9, 10 times greater than what their operating loan would be, that even if they were closely held, never laid off, they just ate up, did not declare a dividend. And now we see a whole new pattern where trustworthy business people, retailers and manufacturers, are being wholesalely destroyed. I'm talking about the destruction of manufacturing in America that will push this nation into the deepest recession the world has ever seen. If we don't make things, we will collapse. That is the impact of the mark-to-marketing rule. Perhaps you don't see that from your perspective because you have to be objective, obviously. You have to find out what's the best standard to use. But I can guarantee you this. IRS doesn't use mark-to-marketing. When one of these small business people die, IRS is in, especially now that the death tax will come back again. They somehow find a value as to these assets. And what's going to be interesting is when I practiced law and I had a situation like that, we oftentimes had to get a loan at a bank to take those assets that the IRS is taxing so much on that the people couldn't pay. I mean, this is how wild this thing is. I mean, it is. And I know we're not here to lecture you, because that doesn't do any good, because it just doesn't do any good. I know you're concerned about it, but when a system that's in place is not working, I mean, for example, Mr. Crocker, you talked about eight different recommendations that you came up with the SEC. They're just recommendations to make recommendations. I mean, you never really got into the meat of it. You know, the accounting for financial asset impairments should be readdressed. That's what you come up with in your December 30th report. That doesn't help the hundreds of thousands of manufacturers, especially the little guys, that actually have orders. What we have now is we actually have manufacturers with real live bona fide orders. They've been praying for orders. And now they've been cut off on their line of credit. And you know what's happening? Those jobs are going overseas. They're going to China. They're going to Korea. They're going all over the place. It is so destructive to have an inflexible system that you have, because what I'm explaining to you is what these guys are going through. Banks want to lend. The community banks have deposits. They're ready to lend. And they're looking at people that have been longtime customers, 30 and 40 years, generations of manufacturers. Gentlemen, they can't get any money. What do I tell them?
Our study did provide recommendations, but we don't expect it to stop there. Those recommendations were made to both the FASB. Some of those relate to us. As I said, we expect action on those recommendations in weeks, not months. My staff doesn't generally set GAAP directly. That authority rests with the Commission, and we've looked to the independent standard setter, whether it be the FASB or their predecessors. The Commission has that ability. My staff stands ready to assist the Commission in any way possible in implementing those recommendations.
Mr. Hers?
You know, at the risk of sounding a little argumentative, but the SEC did a study, and if you go past the very largest banks and look at smaller banks and community banks and all that, most of their assets, the great preponderance of their assets, are not subject to fair value. If you had a community bank that just took in deposits and made loans, there would be no fair value on it. So
no, but they're applying the fair value standard to the security for the loans that they're
to the extent that they have purchased securitized assets, you know, these problem assets, then those are subject to fair value. If they're not being.
It's bleeding all the way through, is what I'm saying. The standard, because the regulators are, you know, perhaps Mr. Bailey, you have the answer. The regulators are picking that up, and the examiners are virtually applying mark-to-marketing to the value of the assets for these secured loans.
And we've obviously explored this issue quite a bit, but when you look at the average community bank, and this is as of year-end data, less than 1% of their assets are in trading assets. I mean, so less than 1% of their assets are where these changes in fair value are reflected in earnings. However, I think, and again, not to repeat myself, I think that further highlights what we said in testimony. The fair value issue for the vast majority of community banks relates to the OTTI issue, since they don't have trading assets. And again, what the issue is presented there, if in fact those assets, whether they're AFS or held to maturity, you know, if there's an impairment, and again, there's the potential for the cliff effect that was described. And again, I think there are potential opportunities to address that problem through adjustments to the fair value, to the impairment model for OTTI.
Well, you better move quickly. They're barely hanging on.
Thank you very much, Mr. Manzul. And now we'll hear
Thank you.
Gentleman from California, Mr. Sherman.
I thank the chairman. I've been reluctant to see Congress legislate generally accepted accounting principles, and in fact, I believe we've never done so. I think the FASB has made some mistakes. I think we in Congress, particularly those of us with a perverse interest in accounting theory, have a right to comment, maybe even persuade. I think perhaps their biggest mistake, other than perhaps market to market, but the biggest mistake is FASB number 2, where you're writing off R&D expenses just because it's easier to do so and insulates the accounting profession from lawsuits, rather than because it helps our economy or our markets. Today, but we have major banks and other regulated companies really issue 3 different income statements. One is their tax return. You have tax accounting, reaches a particular answer as to net income. A second is financial accounting, set by the FASB and related agencies, generally accepted accounting principles. And the third is not GAAP, but rather wrap. This does not mean the accountants involved can be called wrappers, but does the FASB have any objection to this government not setting what is GAAP, but setting what is wrap? And in fact, isn't that what we have traditionally done in this country?
Well, Kevin would probably know better than me, but hello, Congressman Sherman. I was disappointed not to see you earlier, so I'm glad you're here. After the S&L debacle, Congress, as I understood it, and I don't know whether it's in FIREA or FIDICIA, basically said that to the bank regulators that their accounting can be no less stringent than GAAP. Those were the words, as I understand, were used. But that relates to the reporting, not fully to assessments of regulatory capital and capital adequacy, which the regulators do have some flexibility on.
So, but in terms of the century-long tradition of the private sector establishing GAAP, that would not be changed if we asked the regulators in determining when prompt corrective action was necessary to look at a modified financial statement, a wrap financial statement, and perhaps even reverse the policy you just identified. Second, is I understand the accounting theory of mark-to-market, but you're marking to market only a certain portion of the balance sheet, while the rest of the balance sheet uses traditional historic accounting costs. And I'm not sure that you improve it. And one of the purposes of accounting is to allow you to compare similar companies and to see their results. It's my understanding if one bank invests in a bunch of business loans that are not securitized, that are not, and let's face it, we're in a recession. All those business loans are 20% less valuable than they were when they were made. They use traditional historic accounting to determine, and they might write them down a certain amount. If another bank does the virtually same economic circumstance, they invest in business loans, similar businesses. They're both lending to restaurants, for example. But they're investing in a securitized package. So they could be identical. One's Burger King loans, one's McDonald's loans. That you mark to market the second bank, and if there's a market failure, that's a massive write-down. So the question is, does it make sense for the FAS? Now, in normal times, mark-to-market isn't that big a deal. Two portfolios, one dealt with historically, one dealt with mark-to-market, are going to be about the same because the market is logical. But at this time, when mark-to-market gets you a crazy result because there is no market, and where you're supposed to mark-to-market only marketable securities, but instead you're marketing to market securities that used to be marketable that aren't marketable. They're legally marketable now, but as a practical matter are not marketable. Does it make sense to have mark-to-market of formerly marketable, now no longer practically marketable securities? How's that for a long question?
Thank you. Very good elucidation. First of all, a couple of points. One, you are correct that the accounting for loans and securitized loans is not the same. I think a lot of investors would say they ought to be the same. They ought to both be on fair value. Other people would say no, they ought to all be on cost or cost subject to impairment or discounted cash flows. Or
is there anybody that supports the present system where apples on one balance sheet and oranges on another?
I don't think so. And as I mentioned, we have a project jointly with the International Accounting Standards Board, pursuant to recommendations from the securities regulators, the G20, the Financial Stability Forum, to redo the basic accounting for financial instruments, but do it on an international basis. But the second point I want to make is that although we might not like it, there are transactions going on for some of these things, albeit at very low prices. I'm aware of a major financial institution who recently moved a lot of this stuff, sold a lot of these problem assets at very low prices, and they did it in an orderly way.
Which, if anything, just illustrates how non-comparable those two banks were that I described. How your present system is undefendable, and how your international process is probably not going to yield any results anytime soon, which is why if you guys can't act quickly and logically, perhaps the regulatory accountants need to act and depart from what is a somewhat illogical and certainly slow process that you've got. I yield back.
Thank you very much, Mr. Sherman. In reward for patience, I'm going to recognize the gentlelady, Ms. Jenkins.
Thank you, Mr. Chairman. I, too, have heard from a lot of financial institutions in my district on their concerns with mark-to-market standards, and I want to proceed quickly but responsibly. Both Chairman Frank and Mr. Sherman now have touched on this, but I'd like to follow up a bit on the issue of regulatory authority, and perhaps Mr. Bailey might have some additional insight. What I'd be curious to hear is when assessing the regulatory capital of a financial institution, should bank regulators make adjustments to reverse write-downs that relate to the illiquid state of our markets today? And more broadly, what authority do bank regulators have to impart flexibility in regulatory capital requirements? And if the authority exists, to what extent has that authority been used?
That's a very good question, and I tried to address that important question in my written statement, but let me try to summarize the issues. Obviously, when we determine our capital adequacy regulations, we try to use GAAP as a starting point in that assessment process, in part because it does reflect a general market acceptance of how those assets and liabilities and equity should be reflected on bank balance sheets. We do, however, make our own determination as to how those inputs should be reflected in our capital adequacy framework. For example, goodwill, though, is completely recognized under GAAP, but that is not reflected in bank balance sheets because of the clear valuation issues associated with that. So we do have a large degree of flexibility, and we have exercised it. And again, as I indicated in my oral statement in the beginning, I think what we have tried to do in trying to balance the need for a risk-sensitive capital framework, which again is a critical focus of our attention, while at the same time trying to constrain volatility in resulting capital ratios, what we have done, and again, but for these trading portfolios, we have tried to neutralize the effect of temporary fluctuations in value from capital, but reflecting permanent changes in value in bank capital ratios. One other point, so we do have a significant degree of flexibility, and we have exercised it. But I do want to make one other cautionary point. And one of the things that we've looked to in this context is trying to make certain that bank financial statements, including bank capital ratios, have a degree of acceptance in the marketplace by both investors and the broader community. What we have seen some evidence recently that rating agencies and other users of financial statements are creating their own metrics to determine capital adequacy. And we believe what we want to do is make certain that our capital adequacy regulations do reflect the reality that is relevant both for banks as well as users of financial statements. In part because our capital rule is the foundation of significant parts of our supervisory framework. And again, I think what we want to do is maintain the clear relevance of our capital ratios for a broad array of purposes, both supervisory and market related.
Thank you. If I might just follow up, I've also seen some proposals which I understand would separate out credit and non-credit losses. Non-credit losses would be recognized as other comprehensive income and not hit the regulatory capital. Would any of you like to share with the committee your thoughts on that proposal?
Well, I can start off. I think we have discussed that issue quite a bit, and I think that is appropriate because I think that is perhaps one of the most obvious issues that would warrant our attention. As it relates to the capital ratio, to the extent that you reflect in earnings and therefore capital, that the OTTI impairment that's related to credit, but the other impairment, the non-credit impairment that is generally associated with liquidity discounts in other comprehensive income, not earnings and therefore not capital, what that would do is further reduce the volatility of regulatory capital ratios. Because again, under that revised OTTI impairment process, what you're only reflecting as a change in capital is the credit-related impairment. And again, the more liquidity-based volatility is in OCI, other comprehensive income, and therefore not regulatory capital.
Okay.
I agree. I actually think it can provide additional transparency to investors by giving them both a perspective of the credit impairment as well as the impact on valuation of liquidity.
Okay, thank you. Thank you, Mr. Chair. I yield back.
Thank you very much, Ms. Jenkins. And now we'll hear from the gentleman from California, Mr. Royce.
Thank you, Chairman. I appreciate that. And I wanted to ask Mr. Bailey a question. As we look at this mark-to-market at the heart of a larger issue that I think needs to be addressed by this committee, and that is the pro-cyclical nature of capital valuation tools that are being used by regulatory bodies when they compound or exacerbate the peaks and the valleys in the market's performance. And the history of this goes back many years, or at least we have some history in the 30s, and now we have a reoccurring problem. But regulatory nature, regulatory capital, by its very nature, should not take the long view when it comes to valuation when you have a situation where the market becomes, so distressed as it is right now. I think you've got to take the long view. And day-to-day valuations, when they're assessed in this manner, when the markets are going up, fair value accounting valuations artificially inflate the bank's capital and encourage additional risk-taking, encourage additional lending and investing, and in that sense helps create a balloon. And when the markets decline, as we've seen over the last year, the very opposite is true. We had in, I think, 38, the government suspended this kind of, for regulatory capital, this kind of valuation because of this concern, and it came back in I think September of 2007, whenever FAS 157 was put into play, and so now we have this same problem. The observation has been made that if this rigid mark-to-market accounting had been in effect during the 90s when we had our banking trouble, virtually every major commercial bank in the United States would have collapsed because of the loans they'd made in Latin America and in commercial real estate. So we would have had the same kind of consequence that we had during the Depression. That's not to say this caused it, but it compounds the problem. So, and this doesn't go to the question of giving the investors this information. You can certainly do this. The question is, the OCC has the capacity to act on this, and so does the SEC. So I just wanted to ask about regulatory forbearance on the part of the OCC, given the current stress that our markets are under, and what that would mean in terms of providing some respite for many of our financial institutions without impacting the extent to which these firms disclose their assets, because we can still have the disclosure for the investors and the financial statements, and so hence my, I've wondered for some time why there isn't an understanding that you're independent and you can make this decision.
And I think you raise a very important question, and I think there's an important issue that we're looking at in this context is, and clearly procyclicality is one of those considerations. In any risk-based regulatory regime, there will be cyclicality because, again,
right. But you're making the capital calls.
Correct.
And the capital calls are, frankly, what is signaling the market to respond and make these runs on these institutions. So,
yeah, I completely agree. I think the issue, I think by definition, our risk-based rules should be cyclical. I think the issue and the problem arises is whether it's also pro-cyclical in amplifying the peaks and troughs of the normal business cycle.
Right.
And that's certainly an issue that we're exploring in various forums, both domestic and international. But I think what we're trying to do in this context is trying to make certain that our risk-based capital ratio is just that. It is reflective of risk. To the extent we can neutralize the pro-cyclical effects of that regime, we are actively trying to do that.
I understand that, but we have the banks arguably twice as well capitalized. Well, maybe not by these standards, but let's put it this way: twice as much cash in the institutions, right, and yet undercapitalized as we continue to apply this standard. And that's the conundrum I guess we're in. The more, and to go back to my other point about the 90s, in retrospect, had we had this standard, we would be in exactly this same cascading effect on the market today, right?
I think the thrift crisis of the late 80s and early 90s is very informative in this process, and I think one of the things that I think was served to exacerbate the problem and frankly introduce more insidious moral hazard issues is when institutions were allowed to simply ignore their problems. I don't think anybody wants to do that.
No, I don't either. But you have the authority here. And so I guess just to get back to a pointed question, why not use it?
And I think we have used it. And I think when you look at what we have done in terms of those portions of gap that we have not reflected in our regulatory capital regime, I think we can provide you additional information on that, but in writing. But in addition to goodwill, again, which would introduce additional volatility, especially in today's market, is not reflected in capital. And as I said, generally, what we have tried to do is neutralize temporary fluctuations in valuation from regulatory capital. But again, I think it is important for us to reflect permanent changes in a bank's valuation in capital, which we have. But again, I think what we've strived to do throughout this process is eliminate those temporary fluctuations that would result in wild swings in bank capital ratios from the regulatory capital regime. And I think we have done that.
Well, I think at the end of the day, if you see the banks with twice as much capital and afraid to loan because of the consequences of putting into motion, the valuation and then the capital calls that the regulators put on the institutions, and then the raids on the stock, I think you're kind of in a vicious circle here, which until it's addressed might lead us to the conclusion that maybe in 38 the government was right to lift the rule.
Let me be clear. I think we certainly acknowledge that changes are needed in this broad sphere. Especially as it results to how banks need to value and reflect instruments that are clearly in an illiquid market with no observable pricing.
Right. Thank you, Mr. Bailey.
Thank you very much, Mr. Roy.
Mr. Chairman, could I just, for the record, when you were talking about long-term capital management and the moral hazard that rose out of that and the third world debt crisis? Yeah, and that absolutely, I think, is part of what happened more recently.
Thank you very much, Mr. Bacchus. And now we'll hear from the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. I wanted to follow up on just a couple on my comments, my opening comments, in case anybody might not have followed up on the concerns that Mr. Buffett raised on CNBC on Monday. But just prior to getting to that, could you clarify something for me? There's FAS 157, which is used, but there's also a FAS 114. There's some confusion as to the application of FAS 114, and that especially relative to our smaller community banks, and in the process of treating FAS 157 as a standard, are we going to use FAS 114 and treat it in the same fashion that we're treating FAS 157? And if you could just briefly just answer that and explain to me the difference in why the smaller community banks are concerned about this. Why doesn't 157 float across all of them? And what is it about FAS 114 that has a greater applicability to smaller banks?
Thank you. FAS 114 deals with loan accounting and loan loss accounting. If you make a loan, the loans carry it on a historical cost basis, and then when there are probable losses, an allowance is created based upon probable losses, what are called incurred losses. It has nothing to do with fair value. FAS 115, they were both done together after the S&L crisis, deals with accounting for securities. And there is essentially three buckets. There's held to maturity, which is a cost subject to impairment. There's available for sale, which is fair value on the balance sheet, but not in the income statement unless there's an impairment. And then there's a trading account, which is mark-to-market, what people refer to as mark-to-market accounting. Okay. And the issue, and I think Mr. Sherman got a little bit to that, is that you may have loans that become securitized into securities. And there's a different accounting once you securitize them. You go into the 115 accounting rather than the 114 accounting. 157 did not introduce any new fair value requirement at all. All it did was provide a definition and some guidance on how to do it, and a lot more disclosures in the footnotes of where fair value is used and how it impacts the balance sheet and the earnings.
Okay, well, I hope that certainly clears it up for some of our smaller banks. Let me go back then to my original point. In our conversation with Mr. Buffett, the 2 points were, how do we deal with the problems that are associated with the efforts or the effects of the impairments that are taken on assets that are held to maturity?
I've seen accounts of his remarks, and I think as I've seen those accounts, obviously, and I can't speak for Mr. Buffett, I think he was calling for suspension of mark-to-market for regulatory capital purposes. As I've seen the accounts of the remarks, it was that assets or fair value may be good for purposes of general purposes.
Yeah, I think Mr. Buffett, I think what his concern was, he was saying was, should not regulators be required to have additional capital to be held against the write-downs? I think that's
right.
Okay. Let me ask you, loans held in the portfolio and the loans that make up a mortgage-backed security perform virtually the same for purposes of contractual cash flows and should be treated the same for accounting purposes. What are you going to do to clarify the valuation of mortgage-backed securities, particularly those that are held to maturity, in illiquid and non-functioning markets as we have today?
That's, as we discussed earlier, this is one of the key recommendations in the SEC study on off-balance sheet. We expect to see action in a matter of weeks. Again, I think there was discussed a 3-week time frame. We can certainly, from our standpoint, deal with a 3-week time frame in providing additional guidance, but much of that rests with Bob as he's discussed.
Okay. May I follow one final question, Mr. Chairman? Because one of you is Controller General's office represented here?
Control of the currency.
Okay, control of the currency. Well, Mr. Eugene Ludwig, former controller of the currency, stated that perhaps the most dangerous aspect of mark-to-market rules is requiring the remarking of other than temporary or impaired investments. The impairments are severely driving down the values of held-to-maturity assets. Accounting rules should not become a market factor. An application of the OTTI has become such. My question is, what are you doing to control this?
No, I agree with Gene Ludwig's position on that. And again, as it relates to the issue we've talked about during this hearing, and frankly, and probably in each of our written statements, is again, how do you treat OTTI? And again, I think we've seen and has been demonstrated various, very, very compelling stories about significant cliff effects associated with valuation issues once an instrument is impaired and then must be fair valued. And I think what that gets to is the issue we've talked about today, is whether in fact you can differentiate within that impairment the credit portion and the non-credit portion. And if in fact you only put the credit portion through earnings and therefore capital, it would have a significant less volatile effect. And I think we have all acknowledged that there are operational challenges associated with differentiating between credit and non-credit impairment. But frankly, since it is such a focus of the issue and the focus of the comments, I think it is incumbent upon us to see if, in fact, we can work through those issues. Because to me, that is the most significant fair value challenge for community banks.
Good. Thank you, Mr. Chairman.
Thank you very much, Mr. Scott. And now, Mr. Grayson.
Thank you, Mr. Chairman. Gentlemen, there seems to be a clamoring for changing the mark-to-market rules that seems to come largely from institutions that may be insolvent. And that's the pattern that I'm seeing. And I'm wondering if we should try to apply this to other situations in everyday life. I'll give you a few examples if you want. I'm 6'4". It's pretty uncomfortable for me to sit in airplane seats, and sometimes, to be honest, I bump my head when I'm going through a tight door passage. I'm wondering if we should eliminate mark-to-market rules and also make inches larger so that I'd only be 5'8". You know, we have a lot of traffic on the Beltway. I got a suggestion from Freddie Mac recently that if we could just change the ratio of circumference to diameter, pi, if we could just change that ratio, that would move the Beltway further away. So Freddie Mac says to me that it wants to eliminate mark-to-market rules and increase pi to 4 to alleviate the Beltway traffic. I got another suggestion from AIG. The suggestion is that since the Wizards lost to New Orleans this week by a score of 109 to 98, they want to eliminate the mark-to-market rules, and they also want to make sure that 98 is more than 109 in the future so that the Wizards will have won that game. Gentlemen, does it make any sense to kill the messenger when mark-to-market tells you that an institution is insolvent? Let's start with Mr. Croker.
We do not recommend a suspension of fair value, and so to your direct question, no, but there are issues that in our study we think warrant improvement, including the operation of the determination of fair value, as well as how to calculate and report other than temporary impairments. But as it relates to the scorekeeping, if you will, we do not recommend a suspension of fair value.
But isn't that really the heart of the matter? Isn't it the heart of the matter that people not only want to change the rules in the middle of the game, but they want to change the rules when the game is already over, Mr. Hertz?
I don't know whether the game's over or not. I'm just a humble accounting standard setter, but I will observe that a couple of things to that point. The bank stocks continue to trade well below their accounting book value. A majority of the bank stocks are well below their accounting book value. The acquisitions you saw of, I think it was National City by PNC and Wachovia by Wells Fargo, the prices paid by the acquiring banks for the acquired banks was like 30% of the recorded book value. So if the write-offs are excessive, one would expect not to have that kind of thing. I think some of the mark-to-market write-offs may be a little bit excessive, but remember that the single largest financial asset of most of the banks, once you get past the money center banks, are loans. And loans are carried on a cost basis that does not timely reflect the problems that may underlie them. The allowance for loan losses lags the problems.
So let's be clear about this, Mr. Hertz. What you're saying is that the stock market, in its infinite wisdom, is telling us not that the mark-to-market rules have made companies mark down their book values too much, but maybe the accounting rules have made them not mark down their book values enough. Is that what the stock market's telling us right now?
Yeah, I think that's right. I think there's two aspects of that. One is that there's skepticism, A, over the loans, and B, there's skepticism as to whether or not the OTT write-offs have yet been taken, because there is this kind of dam effect, and people kind of, you get like a year, sometimes more. It has to have really been a sustained downward value for a long period of time, and so when the problems started to surface in September of 2007 or August of 2007, the write-downs only really started in the third quarter of 2008, year-end, still, because you get this grace period. There's a cushion.
So what you're suggesting, Mr. Hertz, is that there may be institutions that are insolvent, and they haven't been forced to write down their books to the point yet, and those are maybe the same institutions that are asking us to modify the mark-to-market rules so that they won't have to admit that they're bankrupt. Is that correct?
I share your point of view, and I will tell you that I get calls and visits from some of those institutions that are now in government hands, usually about 2 weeks before they get taken over, trying to get the accounting changed.
Sorry, would you explain that a little further, and then my time is up?
Well, a lot of the people that have been the loudest complainers, and there are valid issues, and we're going to address them. So there are some real valid issues, and we're going to try to address them, give better guidance in that. But clearly, some of the most vocal opponents of fair value and mark-to-market have been some of those institutions that subsequently failed. And
Thank you all.
And have had to have billions of taxpayer dollars put into them.
Thank you all, and thank you, Mr. Chairman.
Thank you very much, Mr. Grayson. Well, I think we may have hit a spot where we can give some relief to this panel and give a little time to the next panel so they can adjust their lives accordingly. The situation is that we're going to have a series of votes in just a few minutes. It will probably take up to an hour to clear that. So when I dismiss this panel, we won't seat the next panel until approximately 2:15. In the meantime, before I dismiss this panel, I just wanted to say that we took very seriously the comments today in regard to a commitment very seriously to work on the next 3 weeks and get that work done expeditiously, I hope, as soon as we leave here today, and that in order to help that along and to assure that we can keep tabs that that's occurring, that when the Congress returns from the Easter Passover work period, we'll convene a new hearing of this subcommittee to specifically get a report on the success of the progress that was indicated today. And that will put a heavy burden on the three panelists, but also, and their respective organizations. But by that time, if satisfactory work hasn't been reported to the committee before the convening of that next session, we'll be working on the legislation that will be able to move through the House expeditiously to cure the problem. I look forward that that won't have to be happening. Look forward to your assistance in that. And if there's anything we can do, as the chairman originally indicated and several other members of the committee, if you need anything, you need additional work, please feel free that you communicate directly and immediately. And we have a new gadget up here in Washington called the telephone. So it doesn't necessitate a letter. It doesn't necessitate anything else. We can be talking instantaneously, and we are available to do that. And with that in mind, I want to thank this panel. You certainly have endured a lot of, shall we say, subtle criticism, and not too subtle, I suspect. But we look forward to working with you. We thank you for your attention to this. I guess particularly Mr. Croker and Mr. Hertz, you took the blunt of our session today. But we're waiting for you, Mr. Bailey. If you're not successful, if you don't put this together and we get a bad report back, we'll give you an equal treatment next time. So thank you very much for being a lively first panel. And to the second panel, we'll convene at 2:15.